trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
Success is a combination of lots of non-correlated or lightly correlated underlyings to reduce risk.
It's better for your investments to trade volatility than it is to own S&P index funds at Vanguard. That's what you're saying.
I can't sleep at night as a passive investor.
Why not?
Because I think the risk is too great. Here I am, I'm a derivatives trader. I have hundreds, if not thousands of positions on, and I sleep fine because I know what I've done. What we do, it's a mathematical equation. What asset other than fear is mean reverting? And it requires no additional capital to play both sides of the market, then why would you even be directional in the first place?
The problem with what you're saying is it makes a little too much sense.
Yeah, it's logical.
And so it raises a lot of
scares the crap
skepticism because it makes a little too much sense.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
If you missed the live show, here's our cherry on top weekly recap.
You have to take a vision test.
Yeah, I test. I will pass. Don't worry.
Well, maybe we can test it out. Is there any way that we can test this out, Vanetta?
I think that there is.
Okay, Thomas.
Can you
why don't you read line
6?
Why don't you start with number 8?
8? Easy. D, E, F, T, G, T, E.
And you're getting a bus pass. Okay, so whose readers do you have over there? Put them on for the people. Let's do it. Let's do a fashion show.
Oh, these are. Okay. With all due respect,
ma'am. Excuse me, ma'am.
How did I smell walking in? Because I was stuck in traffic next to the 35th Street.
Okay, now
okay, 35th Street L stop. Subway stop.
Hey, Sadnoff, that's all you have to do. Make it real easy.
No, just get real close.
I was going to say, better yet, zoom in on. There you go.
Oh, I like this. Tasty After Dark. Yes.
Get the full scoop by checking out the archives at tastylive.com.
How about that ride in? It's Tuesday, March 4th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Thomas Westwater in Chicago, filling in for Dylan Radigan today. We're here for the next hour to talk about whatever that was today. What a market. 100 down, 100 up, 100 back down in the S&P 500. If you're joining us on the platform, if you're on the website, come over to YouTube. Tell us what you're trading today. I'm in the market for a new car, midsize SUV. Tell me what I should buy. If you already have done that, go over to the platform and go to tastylive.com, see what we're all about. Gentlemen, what a day. Tariff talk, obviously, is the prime focus as the tariffs against Canada, Mexico, and China go into effect at midnight. We hear immediately thereafter that the retaliatory tariffs will go into play from those countries. Mexico may wait a few days longer to decide what exactly will be tariffed, but the trade war is on again. Is this a temporary trade war, a one-time shift in prices, or Is this the start of something bigger and much worse? The Fed may not know what to do, but it certainly seems the market thinks that the odds of a cut for the wrong reasons are going up. May favored at one point today as the next 25 basis point rate cut. We see that bond yields, they did make a move lower across the curve before ultimately turning around mid-session, although they get a bounce late in the day with stock prices falling. Gold, silver are able to pick themselves up after a few days of struggles. We see oil prices continue to come down, and the dollar is not really benefiting at all from this tariff talk. Is that a warning sign? We have a lot to cover here over these next 53 minutes. Ilya, we'll start with you. This is a market where we came into the week on better footing. Yesterday, we are slammed lower. Today, it looked like it was getting worse. There's recovery. And then the final 30 minutes arrived. What's up with this price action?
So here goes a theory. The sell-off we've seen in markets really started a week from last Friday. It started with those very scary S&P Global PMI numbers that showed that the service sector shrank for the first time in 25 months. I will quote directly from that report. New order growth weakened sharply and business expectations for the year ahead slumped amid growing concerns and uncertainty related to federal government policies. So, what we have here is business looking at a volatile regulatory, tax, and trade policy landscape and saying, maybe these things are going to happen, maybe they're not going to happen. All I know is I don't know. And I am going to pull back on capital outlays until the dust settles and the fog in front of me is more clear. And that's led to a retrenchment in the engine of U.S. and thereby global economic growth because the U.S. has been the only place growing for the past 6 to 9 months. And in the U.S., it's been the service sector. This helps to explain what we saw today. You get the tariffs. They're obviously a growth threat. But then you get a rebound, and that rebound is driven primarily by tech. It's the NASDAQ that led the rebound. When you look at the breakdown sector-wise, other than tech, almost everything through the peak of the rebound was flat or down, except tech. This makes sense. If you think that the tariffs are going to be damaging, what are they going to be damaging to? The U.S. imports primarily from the goods side of the ledger, which has been anemic. Everything has been driven by services. Services is mainly served by domestic firms. The tariffs largely skate those by, especially the tech firms. And so when you look at the markets and their preoccupation really with U.S. growth for the past several weeks, they see these tariffs and go, wait a minute, but is this a hit to U.S. growth? Not necessarily. Is it a hit to the growth of these other countries? Well, of course, they depend on exporting goods to the U.S. to some extent, in the extent of Canada and Mexico, obviously, to a huge extent. And that's going to be what's impacted. These tariffs are going to be short-lived. This is going to be a motivating sort of influence ahead of the USMCA renegotiations. It expires next year. The U.S. is not going to feel the growth pain because U.S. growth is not on the good side. It's not really impacted that much by external exposure. It's mainly about U.S. demand and services, and there it's about tech. So the rebound starts to make sense. But then read those PMIs again. It's about uncertainty. So the tariffs don't so much represent the economic impact as such. They represent the kind of volatility in policy that business leaders are moving away from, that has them pull back spending, pull back investment intent. So as we look at all of this, let's remember we have the ISM service sector numbers tomorrow. If they look anything like the S&P Global numbers, even remotely, then we are going to be very quickly reminded that we've heard not just from the S&P numbers, but from U.S. consumer confidence data in two different versions, that this is about uncertainty and that economic activity is retrenching not because it is being physically restrained, but because sentiment is unraveling. And if sentiment is unraveling in the U.S. service sector, the global economy has no leg to stand on.
Can we talk about quickly how ridiculous this market still is here after hours? The S&P 500 is back up to 58.14. We dumped into the close at 320, the 320 candle. We were trading up at 58.75. By 3:45, we were down at 57.68. So we have bounced, what's 40 points between friends here in the past 20 minutes. This is precisely
the kind of uncertainty and volatility that the S&P Global PMI writers are talking about.
Thomas, this is obviously a wacky day where if you were bearish going into the close, you felt pretty good, but now you're 40 points on the other side of that. What does this kind of market volatility intraday do to you when you're trying to ride these waves? Is this an appealing environment for you? Do you scale back your position sizing? Are you extending duration? Are you staying away? How do you make head from tails in this? Because I think Ilya and I, being more macro guys, we look at the ups and downs and go, let's wait to the daily close to make a decision.
Yeah, I didn't get too long. I did get long NVIDIA towards the second half of the day. That's just like Ilya mentioned, tech kind of overperforming versus the broader market. One reason I like chip makers still is if there's this increasing competition on the global scale, not only with trade, countries are starting to see, AI as a strategic resource.
Hold on a second. Howard Lutnick's out here saying he thinks Trump will meet Mexico, Canada in the middle on tariffs. He says that we're probably going to be announcing that tomorrow.
Yeah, there we go.
So the trade war.
That's why we're bouncing, maybe. We're going to continue to get whipsawed.
Are you not
like
entertained?
This.
Are you not entertained?
Lutnick also says Canadians like to cheat. So clearly negotiating in good faith. Thomas, go ahead.
Yeah. I mean, the State of the Union is going to be interesting tonight. It's going to be more of a scripted than off-the-cuff thing by Trump. So I think that could help bring some certainty back into the market, perhaps. But a lot of expectations, they've been priced in since last Friday, over the past 2 weeks. Seeing some of the big names like the Mag 7 kind of overperform versus the market, it's a little encouraging. The problem is if you sit on your hands during volatile periods, you miss a lot of the trading opportunity. So it's just about getting more strategic, picking your trades a little more carefully. Like I said, I bought some NVIDIA to get some exposure into tomorrow. We got the Beige Book coming out. We got some more economic data. We got the NFPs on Friday. So still an action-packed week. Volatility could go either way. I think we stay a little expanded on vol for a little bit. I'm not sure how long, but I think you can trade within the confines of higher volatility. And of course, you could do that by taking advantage of volatility to work in your favor. On the other hand, I got a little bit long oil today. Got a little bit long soybeans, or corn that is. So I'm making some moves, but I'm keeping my overall exposure a little dialed back just to hedge some of the uncertainty there. I think this isn't a time where you go all out and you expense a lot of capital. But you definitely got to take your shots here or you're going to miss a lot of these big moves.
Lutnick's full comment here today is, quote, both the Mexicans and the Canadians were on the phone with me all day trying to show that they'll do better, and the president is listening because, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff, but I think he's going to figure it out. You do more and I'll meet you in the middle, end quote. Ilya, this kind of all dovetails with your longstanding theory from day one that all of the tariff talk with our two closest neighbors is effectively a way to renegotiate the USMCA, which you and I can go back and forth, be like, well, why does he hate the USMCA? He's the guy who signed it into law. It's his own trade negotiation. all that aside, which we all know by now, right? Is this the clearest evidence to date that we have that this is a renegotiating tactic for the USMCA, however ham-fisted and disruptive to markets it may be? And ultimately then, if that is the case, how much longer does this sell-off have to go if a big grand trade deal is just around the corner?
I think if you believe that the trade deal is what gave you the sell-off, then you might find optimism in the idea that it's probably not a long-lasting spat. What did we see in the first Trump administration? He said, I'm going to tear up NAFTA. It's the worst agreement ever. And then he does. And everybody clutches their pearls immediately. After some negotiation, we end up with the USMCA, which is nearly identical to NAFTA, but for a little extra section on digital markets. Other than that, there's really very negligible differences. Okay, what's the rhetoric now? USMCA is the worst agreement ever. Is that a familiar sounding script? It doesn't matter that the first Trump administration was the one that signed it, did it, but it expires next year. And there's no time to worry about that next year, because next year you have to run for midterms to try to secure the rest of your agenda if you're the Republican Party and the administration. So you have to do a lot of things up front. Chris, you and I have talked about how this sort of starts to explain why the administration is moving so quickly on so much stuff all at the same time.
The political calendar is a lot shorter than people think it is.
That's right. Next year sets up the beginnings of running for the midterms. That means you need to do the bulk of the stuff that you need to use your political capital on, that you need to flex your mandate on right now. And so that's why the aggressive move on Doge, that's why the aggressive moves on trade. Second half of this year probably gets spent extending the tax cuts to the extent that that's possible with some adjustments. And then next year you run on that. So at this point, we're already into the USMCA renegotiation. You have to do it. It's going to expire next year. So it needs doing. And if you're not going to worry about that next year, then you have to do it now. So the script is nearly identical. All of it looks very familiar. So maybe it isn't the same, but at this point, I'm not sure that you can conclude otherwise with a high probability. It looks awful similar. So ultimately, I think this ends up being something that comes and goes, but it isn't why there is a sell-off. Nothing happened on February the 21st that had to do with this per se that began to motivate this sell-off and the parallel moves in bonds. It was a growth concern. The growth concerns don't go away if we renegotiate USMCA successfully.
Well, I don't know about that. Thomas, it feels like a lot of the growth concerns are stemming from the uncertainty related to tariffs moving forward. If we get a big trade bargain, doesn't that mean that the tariffs aren't going to be bandied around as a threat anymore?
I think a lot of it has to do with how consumers are. We saw consumer sentiment drop off a cliff this last survey. So I think that's concerning.
Both of them, actually.
And
both surveys.
Yeah, both surveys. And you don't see consumer sentiment necessarily rebound right away, or at least I don't think we did if this happened back in 2018. So that's a little concerning for me. Everyday Americans, pinching more dollars now. Is the everyday average American going to just flip their fiscal behavior on household spending just because there's a trade deal done? Or is there already more structural damage, like the COVID relief money finally running out, things like that? Lower rates going to bring a little bit of relief in that way. But again, that takes 12 to 18 to 24 months to trickle down through the economy. So that's really forward looking, and you have to take that and trade off of that now. How are rate cuts going to affect the economy a year and a half out? And is the market going to reflect that in the front end? I think a lot of it's going to have to also do with how China is going to come out, how much stimulus they're going to push, et cetera. But trading this volatility now, I expect to see a relief rally, but my confidence isn't too high on that. A lot of the trade, I think we'd have more clarity if we knew exactly what XYZ Trump wanted to do to get these tariffs to be reeled in from trading partners. You know, one of the things is less fentanyl across the border from Canada and Mexico. Canada already, very little comes through. So what is the real policy objective there? You know, we get these headlines like from Lutnick. It can obviously move the market right away. So I think the important thing to do is watch the news flows and, you know, not necessarily trade off that, but if the price action is telling you to trade off that, you do that.
Yeah.
You know, obviously the price action is the only thing that matters here, of course, at the end of the day. This is just such a, you know, Ilya, I think one of the reasons why I don't trade on a day like today is because I'm a trend follower, right? And if we're in the middle of a falling knife market and there's a rebound coming up, I'm never going to catch the exact low. I may try to catch the low after I see a low being carved out of the top after it's been carved out. But I'm never going to be the person to be like, well, the market's down 3% today, I might as well buy, or it's up 3% today, so I might as well sell. I mean, I guess we could talk about the Lutnick comments or what's happening here after hours. You know, this is just one of the myriad headlines that are appearing today that are significant. I know that Tom doesn't think that the conversation around what's happening with the currencies matters, but I would argue the fact that on Tariff Tuesday, the dollar not responding significantly stronger across the board is, again, one of those noteworthy changes in behavior that kind of raises your eyebrow. Yeah. Because for so long it was tariffs up, dollar up, and now it feels like it's tariffs up, dollar down. Let's pay attention to the fact that Germany just put forward a $500 billion defense bill, and they're going to remove the budget caps on defense spending per this agreement between the CDU, CSU, and SPD. German equities, European equities, the ex-US equities can be seen in a different light throughout all this. So before Tom hops on and says, don't talk about the euro, you have a minute and a half before the police show up. Why should we be paying attention to what's happened in the currency world?
Well, it's really very simple. It speaks directly to what Thomas just said, and this is why a renegotiated USMCA does not change anything about the threat to growth, because it's not about the USMCA. It's about uncertainty. It's about generalized uncertainty and what that uncertainty means. If that uncertainty means businesses are retrenching on growth, what that means is that the Fed has to cut more. It means yield differentials shift against the dollar, because its economic outperformance has meant that they significantly moved in the dollar's favor, as we can clearly see on this euro chart in the back half of last year, when the Fed came out so dovish in September and the market said, no, that's way too dovish. What did we see? From September through to the start of this year, a parallel adjustment in yields in the dollar, all of them to say, the Fed's not going to do nearly as many cuts as they said back in September. We're reversing that move now. Why? Because there has been a meaningful threat to growth. The markets are pricing in more cuts, and the dollar's yield advantage is being lost. Why is that not being countervailed by tariff news? Because nobody is reasonably looking at this as being a tariff thing necessarily. Tariffs would imply redirecting capital flows from imports to domestic markets, hence the dollar's strength. If you were finding substitutes for imports domestically as motivated by the tariffs, that would be a response that makes sense. What substitutes? First of all, if the tariffs don't happen because there is a renegotiation and they're very short-lived, then the point is moot. Meanwhile, the growth scare remains because it's not about the tariffs, it's about the uncertainty. Second, there's not ready substitutes. And of course, third, to the extent that this is a situation having to do with goods, because that's what we import, that demand is already anemic. The issue is about confidence, and it's not about confidence on the goods side. It's about confidence on the service side, which is why this is much more about business sentiment. And business sentiment is not going to get fixed in the service sector if there is a goods-oriented USMCA deal.
Can we talk about the private sector for a second? I shared this with Thomas today. He was asking me about the various quips that we've heard from the brilliant minds over at the All In Pod about how we really need an alternative measure to GDP, because the one that we currently have is obviously overstating the value of government spending, and it's overall inflating a fake economy here. We have alternative measures of GDP. There's one that you can look up right now on the Federal Reserve's economic data website called the value added by industry, private services producing industries as a percent of GDP. So basically everything that's not government. Anyway, the private services producing industry percent of GDP is at 72.1% as of Q3 24. That's up from where it was in 2020 when it was 70.7%. It's higher than where it was at the start of 2016 at 72.2%. It's higher than where it was before the global financial crisis when it was 66%. The private services producing industries have never been a larger part of the U.S. economy. So to suggest that government spending or government activity has been crowding them out, if that were the case, the chart would go from top left to bottom right, not bottom left to top right. So, Ilya, maybe the fact that the private sector, maybe the private sector is getting a lot more support from knock-on effects. Just because we're cutting spending to Ukraine, what does that really mean? We're not going to be buying stuff from defense contractors here in the U.S., which means defense contractors don't need as many people in their factories. So knock-on effect, all these people who are private citizens who don't work directly for the federal government end up losing work. It's a knock-on effect. 25% of people who work in America right now are subcontractors or directly work for the federal government. 1 in 4. It's a huge impact for spending moving forward if this were to play out. You mentioned the rate differentials. I think a chart that we need to focus on here is what happened with the 10-year. That's a big reversal today in ZN, and it occurs at a point where we have been talking about the market potentially falling since early February. That swing level that you had near 4.15% in early December. Ilya, is this a natural stopping point for the market? I mean, if yields stop falling here, is this a place where stocks can bounce then moving forward?
Certainly a point to consider, and lines up very neatly with what the S&P did today, which is kind of scrape the bottom of an analog range. So when you look at this, it really starts to look like decision time. So it's only right, I think, that the markets pause here. Before you go and say that pausing here means that the next step is a rebound, though, I think you have to remember that markets trend. If they always respected support and always respected resistance, they would be in a perpetual range. At some point, these levels of support are going to give. And just because we've paused here, which is a logical spot to pause, to consider what happens next, does not mean that we're not tomorrow going to slice through this, or the day after, or the day after that. It also, of course, doesn't mean that we're not going to bounce again, but you want to let the price action speak. You don't want to assume that just because there is support that it's going to hold. It may not. You don't want to assume on the bonds that just because there is resistance on the 10-year, that that's going to hold, and it's not going to rip. And I think there's every reason to think, I think you see it very clearly if you zoom in, let's say, to an 8-hour chart on any stock index, S&P or NASDAQ, that the bearish dynamics we've been watching have not been overturned. It has not by today's rally or anything like it. It has been a clear stair step down. What did we do today? We retested former support as resistance. What did we do on the previous bounce? The one that people were trying to buy the dip on before. We retested previous support as resistance. This is a trending market. It's just trending down. And you're watching it stair step and respect levels, both on the way down, when it cracks, there's follow through, and then on the bounces. When it bounces, it does not overcome the prior barrier. Instead, it comes back, tests it, and shows you, no, I meant to break that. I am not going back over.
It seems like there's a lot of that here recently. When we fell into this level that we just fell into, actually, the lows that you have going back to early October in the ES continuous contract, it's an area on the daily time frame when we put this 200-day moving average on it. That's in vogue again all of a sudden. The NASDAQ briefly dipped below it today for the first time in 333 trading days. We see that ES is able to catch that area where the closing lows are in early October, early November, and that's where that 200-day comes into play. And sure enough, we do get a little lift there. The lift continues. We close at 57.89.5. We're in at 58.26.25 right now. Clear little bounce after hours. But that is one of the notable things in this market, Ellie. I mean, we think about the NASDAQ price action yesterday. Granted, today is a turnaround. But yesterday we open higher. We move above the Friday high. We nearly close below the Friday low. That's not something that happens in bull markets. That's a bearish engulfing bar on the wrong side of this moving average envelope. How many times have you heard me say when the market was trending higher, bullish outside engulfing bar, momentum's positive, why wouldn't I get off this trade? Like, why wouldn't I hold on still? If I'm a bear and I look at this market rebound today, there's almost nothing that convinces me that we have wiped out or washed out yet. But for one thing, and I suppose this is the single thing that I'm paying attention to that has me scratching my head today, it's the volume figures in ES.
Yeah.
That's enormous. I think, let me just contextualize this here, guys. Today we traded 3.23 million contracts in ES. The last time that we saw 3 million contracts traded in ES, you have to go back to Monday, August 5th. Monday, August 5th, if you thought that was capitulation, you nailed it because that was the low. Before then, the last time that we got close to 3 million traded, we're talking about moves in October 23. You're talking about moves in March 2023. March 2023, obviously an interesting time. Why? Because the market is bottoming out with the Silicon Valley crisis. So that's kind of what's that's grinding my gears here a little bit today. We have this keynote address tonight, Mr. Westwater. That seems like it's a bottle of chaos waiting to be uncorked. Maybe I'm thinking about my evening plans. Either way, I'll be drinking during the announcement, during the press conference, during whatever this is. But if this is a washout, right at the 200-day, right at the September and October lows, 3 million plus contracts traded, and now Lutnick's out here bandying the possibility that Canada and Mexico are going to come to the table tomorrow. Maybe Nick Batista's right. Should we take an old 1 or 2 DTE swing off the lows here and say YOLO?
Yeah, I mean, with the VIX, you obviously see some really sharp contractions when you get to 25 around these levels. So historically, I mean, it makes sense that there's some easement in volatility here. The State of the Union, whether it offers certainty or more uncertainty, I'm not sure. I'll be watching too. I just don't know if we see trading on it until tomorrow morning. The high volume is notable, but you don't know if that's it could be people getting in bottom fishing, it could be people capitulating from the long side, or it's likely both. So the volume alone, I don't think it tells you whether to get long or short. If anything, I think it tells you maybe to be a little more cautious. But there's definitely a lot of uncertainty here. We're below the election levels now. So going back to what Ilya said, I think this is more about growth than it is about tariffs, because we knew tariffs were coming. They were signaling that far before these were put on. It's just we didn't know exactly what was going to happen, what the retaliation was going to be. Mexico and Canada obviously incentivized to make a deal sooner rather than later. China as well, but that probably won't happen until we get the neighbors figured out. But if what Lutnick says is true, and we do see, a notable move towards a deal being made, I think that's at least going to give the market some relief. I think the VIX is going to come in. I think you're going to see a relief rally in equities. I think technology stocks, chip makers are going to lead that rally. It comes down to how do you protect yourself if you're trying to trade on the long side. Whether you're trying to diversify through bonds, currencies. Right now, I like being long non-dollar U.S. non-U.S. currencies. Bonds topping in the short term is definitely conducive to a relief rally coming on if we're pinging these levels. We get some yields coming in. It's going to be interesting to see what happens between the State of the Union tonight and what happens shortly after the open tomorrow, the first 30 minutes. I think a fade would be brought up pretty quick just looking at the candle on today's ES and NQ. We see that long tail down there. That was buyers coming in at those levels. We didn't see that yesterday. Yesterday we had more of a follow through to the downside. So I'm going to be looking at getting more long, but cautiously. But however, I think ultimately this rally or this sell-off has potentially more room to go because we've seen comments from the administration, put out and then walked back, and they could put out comments, but if the other side isn't really in agreement, and miscommunication can happen so easily on these things that, does it fluff the market up a little bit, these comments? But then you have to, if they're walked back, that's even more of like a double whammy where you could see that sentiment deteriorate even further because that's showing that the two sides are not in agreement. And that just tells the markets more uncertainty is on the way.
Mm-hmm. I see, a lot of commentary in here, like, we're just or the U.S. is just reorienting its place in the middle of the world. I don't know about anyone else. I'm a big avid reader of history. I would suggest people look into how the Portuguese Empire has failed after it reoriented its position in the world, or the Spanish Empire, or the British Empire. We could go to the Roman Empire or the Ming Dynasty in China. If you catch my drift, all these countries that tried to manage their way out of being the empire have never rebounded, right? The collapse of the Ming Dynasty is particularly, interesting. Peasant uprisings, expensive wars, abuses of power by the ruling class, severe financial downturn, agriculture disaster. Thomas, speaking of agriculture disasters, the Trump tariffs against China seemingly are going to bring about another round of farm bailouts. Is there a way to play that wedge between the commodities and different individual stock tickers that are operating in the farm space? Because it feels like there needs to be a little bit more pressure in those farmer equity names if these tariffs are going to be sticking around.
Yeah, I don't play the equity names for them too much. China did slap restrictions on 3 firms that export soybeans today, as well as the additional 10% tariff on soybeans. I think that's up from 25, so 35% now. 15% on wheat, corn. So we're definitely seeing those moves, in the prices today for soybeans, corn, wheat. It's how you play it. 2018, the trade war 1.0, it kind of decimated that soybean industry in the U.S. Brazil stepped in to be the main exporter to China, and that has not flipped around since 2018. So Brazil still has the top spot for exporting to soybeans to China, and they're the largest consumer of a lot of AG products. So that's a market you want to be in. Bailouts are going to have to come just like they did last time. It's still relatively small as, a percent of the entire deficit spending. But I don't know on the individual names. I know for these AG products, soybeans net positioning is pretty much flat. Corn traders were really long going into this. So you see a lot of capitulation in these long positions because they were already long. It was expected to be a good year for corn. Now we got tariffs, which is a big question mark over that industry. So how is that going to play out? It's going to be unpopular among Trump's base, but how much the pushback is on that and how quick the subsidies come. I know the Farm Bill is in works right now. That's kind of been behind the scenes with all this stuff on tariffs happening and other stuff. But there does have to be bailouts if these tariffs go on for more than a couple months, because that's when the supply chain really gets hit. So China's saying that they found some fungus on soybeans. That's pretty much just an excuse to.
That's a bunch of bullshit.
Yeah,
that's what you call a non-tariff trade barrier.
Right. There's always something you can pin it on, and that's probably just so they're trying to signal that they're not directly responding to tariffs, but it's measured, right? 10%, 15% isn't anywhere as much as they could go. Some analysts saying they could go all the way up to 60%. If that happened, that would effectively stop all exports to China for AG products. I think corn has perhaps more downside. I think at this point you need to see a little relief rally here. But again, these long positions, if these tariffs go on for more than a couple weeks, a few weeks, those long positions are going to start getting washed out. And it's an elevated position. So you could see this sell-off pushes back further, maybe another $50 on corn, $40-50.
If it follows the path of what it did last time around, you probably see a domestic oversupply of some of the soft ags in the market, which is why corn and the various soft ags have been getting hit the past 2 days. But what did we learn longer term? Prices probably go back up, right? Yeah. Because this is, as prices come in, it's going to take out, it's going to bring the production point below break evens for some producers. And so then you're going to take producers out of the market longer term, which makes our domestic supply more volatile and can lead to more price volatility. We still haven't recovered. Brazil, as you said, filled the gap here. But, I question, this is what really throws me for a loop. Maybe people in the chat have a different interpretation here. I don't know if anyone caught the conversation between Howard Lutnick and Joe Kernan earlier today on CNBC. Joe Kernan, for those that are unaware, he's not exactly a left-leaning guy. Seems to be one of the more vocal Trump supporters on CNBC, just given where everyone stands right now. Fair enough. Everyone's entitled to their opinion, their own disposition. But Kernan was talking with Lutnick today. They were talking about the tariffs, and they were talking about inflation. Lutnick says inflation comes from government printing more money. And Kernan says, you don't think it comes from the tariffs? To which Lutnick replies, no, tariffs do not create inflation. This concept is just people whining and complaining. I was under the impression that if the cost of goods go up at the border when I import them, and if I want to keep my margins in place, I need to pass on that cost to consumers. If I don't pass on the cost to consumers, then my margins go down. I, as the producer, make less money. This is still America. This is still a capitalist economy. The goal as a shareholder, as a management team, is to extract every single possible dollar to boost shareholder value. So if I am a company whose edict is to maximize shareholder value, and I have an increased cost in my bottom line that I can pass on to a willing consumer who will give me more money for said product or service, why wouldn't I raise prices out of some purely patriotic duty? That's a really asinine thing to suggest. Just
you would, unless you thought that they couldn't absorb it because they wouldn't buy the stuff, which would then saddle you with the other problem of how is this not recessionary? And so really the question is it inflationary? Yeah, as long as the economy is okay. And if the economy is not okay, the only reason it's not inflationary is because the economy is in a much more dire state. So the only way that something like this isn't an inflation motivator is if companies are so scared of killing demand that they don't pass it through. And the question then is, why are they so scared? And is that a good thing? So no easy answers here for this kind of rose-tinted view of tariffs don't raise inflation, but also they're fine for growth. La-di-da. It's not how that works.
I guess the good news for the metal monkeys among us, like myself, more uncertainty, rebound for gold and silver. I've been riding this out, guys. That pullback that we had last week, I just grinned and bore it because I have my very stubborn views on how the world works. And the way the world works means that if gold was going to continue going up, it should have held at the October 30th high. And it did on Friday. Ilya, now that we're back to the midpoint of the recent trading range, which is roughly $125 wide, and gold vol is starting to perk back up, something we like to see when markets are getting ready to go up. What do you take about gold in all this, given how it's responded last week, how it's responded this week to the tariff on, tariff off, and maybe they're off tomorrow, trade war, news flow?
I think you have to be really cautious about thinking that this is a bounce that lasts, and that maybe you have a little bit of a bigger wash until you are convinced that you don't. Because if you believe that the backfill in, let's say, NASDAQ, S&P, if you believe that the price action there is telling you you're stair-stepping lower, and all you've done today with that rebound intraday is retest former support as resistance, you have to believe the price action is in gold is telling you something similar. Look at what happens today. You run up, fade, and come back in to where you fail to overcome the previous level of support. If you just look 3 candles back, you have that initial leg down with the big bearish engulfing pattern, big bearish engulfing candle, however you want to call it, at the top there in gold. You then have a day of pause and then the break. Well, we retested the bounds of the pause here, that initial support, and we failed to overcome. Now, I'm a gold bull in this kind of an environment where yields are tanking. So I generally expect gold to be some sort of a buying opportunity, but I'm still holding out for perhaps lower levels than this.
Thomas, do you have any strong feelings on gold, silver here at these levels as we make our turn through the midpoint of the week?
I'm still long gold. 29.20. I sold the put at. I like it here with the view that the dollar is going to continue to go down, being long non-U.S. currencies. The liquidation last week that we saw, the flight to cash, in my opinion, that's probably over. Just the behavior we saw the past few days. So I still like it here. I would have liked to see, Ilya mentioned that we paused at the indecision level from, I believe it was the 27th. That's a little concerning, seeing that long tail on the candle today. I'm going to be watching it closely, managing it. The thing is, if we go back and retest like 28.65 and we fail under there, I would let my gold go for a while and probably look to re-enter at a better price. Once we do get over 3,000, I think we make a run again. But I think right here is a indecisive between 29, 80, 2,900 to where we are right now. I think there's a lot of indecision. So I think we need to find a direction. But I'm inclined to go on the long side right here because I think the dollar is going to come back in more I think yields are going to go down a little more. So I do like gold, and I like it as a longer term trade for this year. But it's all about managing the short term. I have a lot of 51 days out on my position, so I think I got time to hold.
That makes perfect sense to me. I mean, I sort of got myself into trouble trying to be too cute with this. I initially got long mid-December and rode it all the way into the highs that retested November's tops around 28.50. And when we got some vertigo there, got out just ahead of those highs, and then missed basically 50% of the overall rally from mid-December through that February top. I caught the first half, not the second half. So getting shaken out didn't work. I mean, it made money, but it didn't work to capture the sort of full spectrum, if you will, of the move. So I'm mindful of that. I do want to be on the long side, and I don't want to over-engineer this and get too cute. But I think you do have to look at the price action. And to Thomas's point, I think this is kind of a weird area. And there's not really the kind of conviction that gets you sold unless you get through some of these levels. And really, if you take out that big top near 3,000, and then you really run. So I'm looking for where to get back long. It does seem like still a bit of a shaky thing. I agree with Thomas that ultimately a weaker dollar and falling yields will be very good for gold. The tricky bit is that gold has been going up and ignoring the dollar and ignoring yields, and then not, and then ignoring them, and then not, on and off, depending on what yields and the dollar were doing the past several months. Gold, for its part, just was going higher from mid-December. And it seems like the motivator there was mainly buying from China, where the market said, you know what, we can ignore the macro fluctuations. They're all kind of rangy anyway. There's the giant gorilla of a buyer out there skewing this market. The most recent numbers out of China in January, though, are a little bit sobering. The Gold Council makes this very clear. On one hand, official sources bought a bunch of gold again. On the other hand, the outflow from Chinese gold ETFs was about equivalent to what officials bought. And so on net, China was basically a scratch on gold inflow and outflow in January. And that's a layer in this conversation that might explain why all of a sudden in February gold stops, even as yields accelerate lower, even as the dollar accelerates lower. Because the conversation is about what is this giant thumb on the scale doing? Should we be taking a more holistic view of why the situation in China is what it is, why officials are buying, and whether that's the only thing that matters as far as China's influence? So I think ultimately Thomas is right. Gold is going to be about yields, and it's going to be about the dollar. And that means it's going higher most likely. But the fuzz here near term might still give you a little bit of back and forth regardless of what the dollar and yields do. And it might be China related. So I'm inclined to just follow the price action in a more rigid way here without overwriting the narrative and say, you know what? If this was a stair step down, we didn't get back on the higher step here. Let's get back up on it. Then I'll feel better and I'll buy.
Commodities do turn around over the course of the day. They're off the lows. Copper prices are of interest to me. I'm leaning long deltas in gold, silver, and copper here. Like we saw in late January, early February, after a pullback, we noticed that we're cusping or gripping that 1 month moving average, the yellow line here, as support. So we have our breakout. We pull back in. We're treating the former highs in November and again here in January, former resistance turn support and hugging that 1 month moving average still. So I'm short a put spread here in HG. I have call spreads in GCSI. I suppose as we wrap this up, we have to talk about the remaining bit of a rent risk for today. Guys, we have not a State of the Union, but an address to a joint session of Congress. Not a State of the Union because it's the first one of the term, and he can't really give you a year in review, considering he's only been in office for 5.5 weeks, 6 weeks. Is this another vol event, Ilya? Thomas, let's start with you. Given the fact that Trump seems to be wanting to pitch his vision of America to the American people, and this is his biggest audience yet, why should we expect anything other than MAGA turned up to 1,000%?
No, because, Trump's scripted speeches have usually been more reined in versus his off-the-cuff remarks, which, that's a lot of what we see from him is him just freely talking. Versus a speech like this is going to be more already written, and the delivery is probably going to be a little more eloquent versus what we see, just day to day from him. So I don't necessarily think it's going to be a vol event.
Ilya?
I am of two minds here. I think that what Thomas says makes a lot of sense. When the president is scripted and when you get these kinds of occasions, he typically tries to strike a conciliatory tone. That's what we learned from the first administration. On the other hand, this version, the Trump 2.0 version, has been a lot more combative. We saw this in the inauguration speech. The inauguration speech was not a unifying speech. It was all fire and brimstone. So it could be a risk event in that sense. The tone has changed. On the other hand, I think at the end of the day, this is not about the tone of a speech so much as it is about economic growth and uncertainty in the business community and amongst consumers as the building threat to that growth. So I think if the audience walks away from the speech still uncertain about what comes next, whether the speech is combative or it isn't, that's what matters. And in that, I think it absolutely marks a threat. I do think the markets are going to wait until the ISM data tomorrow to make that perspective known. I think that's the next tangible inflection point. If that looks anything like the S&P Global version, markets are going to very quickly conclude that the problem here, tone, not tone, tariffs, not tariffs. The problem here is that businesses are uncertain and they don't want to lay money out there. Consumers are uncertain and they don't want to lay money out there. And this is a tangible hit to growth. That's the issue.
That's the issue. And I think that's the most important point here, right? If we know which way things are going, people then can price in that future. We don't know if the tariffs are temporary, they're not temporary, if they're going to be here tomorrow, next week. If Trump came out tonight and said tariffs are going to be on guaranteed for a year minimum, I'm not going to take them off. I'm going to seek a congressional act to make sure the tariffs stay in place for at least a year, right?
Rally.
So they're not market's going to rally.
Because it's not about the veracity of the policy. I couldn't possibly agree anymore, Chris. It's not about whether you think the policy is good or bad. Markets don't care if the policy is bad. They can price that in too.
Yeah, we'll just sort the winners from the losers. We'll just send down Canadian lumber producers with mills in the U.S. will stay down. Home builders will stay down. But if you're a U.S. Lumber producer, any paper product supplier like IFP, then you're going to do fine. So it just becomes a sorting mechanism for who the winners and losers will be on a longer term scale. But with that, we'll remind everyone that trade wars are good and easy to win. So overtime is out of time for this Tuesday, March 4th, 2025. We'll be back tomorrow, same time, same place, as always, right after Last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Thomas Westwater in Chicago, I've been Chris Vecchio in New York. Good luck trading the rest of tonight. See you in a little bit here. Macro Money up next with Ilya Spivak.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tastylive.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed
RV.
up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
Oh, and then I vociferously stood up for you.
Of course you did. You should have, because that was the smart move.
I appreciate you. You're
yeah.
good.
Saturday morning, I look at my phone, and it says Venmo, $20.
I almost had to pay him $40 because there was a little stipulation. If I didn't sleep there one night at all, I'd have to double the bet. I almost had to send him $40.
What happened?
See what happened?
Here, what happened was
we're driving up there. It's absolutely beautiful. It's like sunny as can be.
You were tweeting pictures.
Oh, yeah, it was
the
beautiful.
Girl
It was
on
beautiful.
Instagram, you're like, I'm here in the woods.
Absolutely beautiful. Absolutely beautiful.
Amazing.
It was gorgeous. We were gonna make a slight right-hand turn. We got about 10 miles to go, and up ahead there's this dark cloud, and it's raining. It started getting muddy, and dogs are getting all muddy. Wife's having a little problem. Bugs are everywhere from the rain. And I realized at that moment that my wife was not a camping gal.
That's a surprise.
So at 6 o'clock in the morning, I pulled everything out, closed everything up, shoved everything underneath, and I was home. We actually left because we did the show at 10 o'clock in the morning. I said we left at 10:30. I was home at 10 o'clock in the morning the next day. Look at him.
You were just
Jumped in my pool, looked back at my house, and I said, why would I ever leave? Why?
He was going to go fishing, catch.
He's hurt on this one.
Muskies. Some bass.
Very quiet.
I left Friday at 10:30. I was back Saturday at 10.
AM?
Yeah.
You didn't make it 24 hours?
No.
Who broke down?
They all did. They all did. I rented a boat for Saturday, but the boat was broken. It rained for 5 hours. You know, when we got there, it was...
Now the RV on rvtrader.com.
No.
Yeah.
Whoa, wait a minute. How do you get to Florida now?
I don't care anymore.
Oh my God. First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow, let's take a look.
They did not hold that rally at all.
Phil, you got a partial.
973.75. I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this to me. And then, you know what? Money goes to money. You did it. Good job out of you. Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours. Okay, I need help understanding. This is the largest monitor that I've ever seen. Like, I have to move back in order to see everything. And somehow when you're on air, you're like...
Nope, I got everything fine. The problem is I just have a lot to do. You see, because in your job...
Oh, here we go.
Really, all you have to do...
Get the full scoop by checking out the archives at tastylive.com.
It's Tariff Armageddon, and then it isn't, and then maybe it is again. Very sharp swings in the markets today as we get tariffs triggered by the United States against Canada, Mexico, and an additional 10% tariff on China on top of the ones announced last month. The markets seesaw violently around the news. And of course, the question now with all of us that are participating is this a bottom on the recent selling? Or is this just a waypoint on the way lower? That's what we're going to tackle here. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we're going to unpick this whole story. We're going to unpick what happened with the price action. We're going to see why this price action probably occurred and what it might mean going forward as some new event risk comes along, and how contact with this event risk might put us back on the defensive, not just in stock markets, but elsewhere too. So let's break this down. I look at the NASDAQ here as the stand-in for what equities did today, because the rebound that we subsequently saw from what you see was at one point a dramatic sell-off was really focused on the NASDAQ, and that's part of this story. So as we open today, as we mentioned at the top of the show, we got a bit of news that got markets clearly concerned. There was a month pause in the levying of 25% tariffs on Canada and Mexico after conversations that President Trump had with leaders of those countries. That sort of a delay expired today. Those tariffs went into effect. A month ago, China was hit with 10% tariffs on top of those that were already there through the first Trump administration and the Biden one. A further 10% announced today. So the markets looked at this and said, well, this is bad news. And at one point, the NASDAQ was down over 2.5%. The S&P was down over 2%. The Russell was down close to 3%. And then we got a dramatic intraday reversal. As we can see here, we were looking at the wicks on this candle, much lower than we ended up. Ultimately, the NASDAQ finished the day with a much more manageable decline, off only about 0.3%. And not surprisingly, the question then becomes, well, what gives? If the tariffs were such a concern, why? And if they then weren't a concern, why that? And it does, strange though it may seem, make quite a bit of sense. Why were the tariffs a concern to begin with? Well, remember that the sell-off in stock markets did not begin with the tariffs, not directly in any case. It began with this economic data you see on your screen. This right here, this start of the sell-off that you see, really starts to reflect economic growth concerns. And that's not just for NASDAQ, that's across the major indices. And the really big inflection point in this story comes a week from last Friday, a week back from last Friday. That would be, if you want to check it, February the 21st. And that is with the release of this PMI data showing that the service sector in the U.S. shrank for the first time in 25 months. This is, of course, as all PMI data centered around 50. That's neutral, neither growth nor contraction. Above 50 is expansion. Below 50, economic activity is shrinking for the given sector. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So two things to note here. Number one, as we can see, services is overwhelmingly the driver of U.S. economic activity growth because the composite index that includes both services and manufacturing looks almost identical to the services line, while manufacturing kind of meanders on its own. This is not unusual. In fact, this largely is echoed in the performance of most major economies, and not just developed ones. China, for example, looks pretty much like this also. So services clearly is the main story here, and they weakened significantly in January. See that here. And the overall weakened with them, despite manufacturing starting to cautiously improve, or at least appear to. But it was really that slide in February, continuing for a second month, the cool-off in services that got everybody spooked and thinking about recession risk. Why did this activity drop-off occur? Well, let's go to S&P Global, who wrote the report. What do they cite? Growing concerns and uncertainty related to federal government policies. Meanwhile, the uptick in manufacturing linked to front-running of tariffs. Why? Well, consider what this means. When we look at the mix, goods to services, we find that the U.S. economy overwhelmingly imports goods, whereas service demand is primarily serviced domestically. So it is very much concerning that the service sector is worried about policy uncertainty, because tariffs don't inherently strike, at least not directly, at the service sector. They're much more focused on goods. And so when you consider what is happening here in total, you see that manufacturing gets a little bit of a pickup because manufacturers that use imported goods inputs into what they're doing, certainly for automakers, let's say, this is a very big deal when you consider how supply chains stretch across the Canadian and Mexican borders, for example. It makes perfect sense that on the expectation of tariffs, there would be a push to buy more stuff and to ramp up production and to build inventories. Because after whatever tariffs were threatened on the campaign trail and have been promised all along, finally arrive. And on the off chance that they don't arrive, well, good, positive surprise. But on the off chance that they do, you've managed to secure inventory at a pre-tariff cost level. So business leaders looking at the tariffs as a whole were already reacting where they were directly exposed. But the impact on sentiment in the service sector, which isn't directly exposed, that's the trouble here. And that sentiment was clearly deteriorating. That was reinforced by signs we saw in other data, certainly very similar echoes for very similar reasons in all of the consumer confidence data we've seen for February, be it from the University of Michigan or from the Conference Board. But most importantly, what we learned here is the problem isn't the substance of the economic hit from the trade war. In fact, anticipation of the trade war has been, if anything, supportive on the manufacturing side, as people try to front-run that. Rather, the issue has been sentiment on the service side. And this is really the threat. Consider what we just saw from the latest CPI data, and we can see that all of sticky inflation is centered on the service sector. If we look at the actual contributions, we can see for the latest 3% rise in headline CPI, 2.6 percentage points was the service sector. Goods were a little bit less of a rounding error, but nevertheless, that. And so when you look at what is actually driving U.S. growth and U.S. outperformance relative to other economies, it's very clear that it's the service sector that's doing it. Moreover, when you look at the contributions to CPI for January's report, what you find is that the service sector's contribution actually weakened, and that the uptick in headline CPI mainly had to do with the contribution from goods improving and the contribution from energy improving. And that mainly comes from those things going, in the case of energy, from negative to mildly positive, and the goods side from going to a lower negative quotient versus a slightly larger one. So this seems to confirm what the PMIs are warning us about, that the issue here really is the unraveling of the service sector. That's the threat to growth, and that the reason it's unraveling is sentiment. Because it is a concern about policy uncertainty that has businesses retrenching on spending, retrenching on investment, just waiting to save their money until the dust settles. Now, of course, we've likewise pointed out here that the markets are doubly concerned because of the outsized share that the U.S. service sector, in that it powers the U.S., the outsized share that it's had to play for global growth. We can see here 58% of global GDP is just three economies, and that's before we consider that the other 42% are mainly vendors to the former three. That is to say, countries like Mexico and Canada, in that rest of world 42% there, rely on demand from the U.S. in order to have a global GDP contribution, much like Central Europe or Nordic Europe relies on the Eurozone, Australia, New Zealand, Southeast Asia And a lot of the commodity producers in Latin America or Africa, they're reliant on China. So if we consider then that the global economy is mainly driven by three engines of demand, we see how those engines have performed in recent months, we find that since the middle of last year, Eurozone and Chinese economic activity has trended lower and hasn't rebounded. It was the U.S. powering global growth, and in the past 2 months, that seems to be coming undone. Now, we have already seen over the course of January what this means. Of course, February was more dramatic, but we don't have full global data on that yet. As we can see here, Chinese numbers are still incoming. But as of January, we can already see that the unraveling of the U.S. is unraveling overall global PMI. There it is right here, the composite index in the dark line there in the middle. Moreover, we can see that global growth hasn't really moved ahead and has been begrudgingly drifting down since the middle of last year, despite U.S. outperformance. So despite this, and that is because, as we just mentioned, growth in the U.S. is primarily the service sector, and the service sector is primarily serviced by domestic firms. This is why U.S. outperformance has not spilled over globally for the most part. Now, on one hand, this means that the tariffs don't necessarily threaten U.S. growth so much it is driven by domestic demand and services, and perhaps that helps to explain why we got this seesaw. Yes, the markets initially didn't like the tariffs because they're a hit to growth at face value, but perhaps not such a hit if that growth is driven by services, as is evidenced by the CPI and the absence of the spillover from U.S. outperformance to other major economies. China is a ready spillover target, as is Europe. Both are meaningful goods exporters to the U.S., but because the breakdown has favored services and not goods, maybe this is not a big threat. So you get the seesaw. But then, of course, you are reminded that it's not about the threat to growth, as we've just discussed. It is about the threat to sentiment in the service sector from policy volatility. And so if you get this continuing, if this suggests, on the one hand, that the U.S. might be relatively impervious, at least U.S. growth might be relatively impervious in aggregate to more tariffs because it strikes at a part that isn't the dominant engine of expansion now, you nevertheless get a sense that if all of this back and forth creates more uncertainty and more retrenchment in a preemptive way from service sector leaders, as we've seen already, then this pullback in the PMIs very unfavorably threatens global GDP. You can see here the PMIs are a great forward-looking view on that. They track GDP numbers closely. They're just much more timely than the GDP numbers are. So it is with this in mind that we cast a worried eye on the ISM version of PMIs. That's incoming over the next less than 24 hours. We've already gotten the manufacturing side of the equation, and it was actually a bit weaker than expected, which already is a bit soggier than what happened with the S&P Global version of this data. Again, let's look over here, and we can see in the S&P Global version, manufacturing got a bit stronger in February, even though the service sector was a bloodbath. These numbers, on a survey conducted later than the S&P one, sentiment is already a bit weaker even in manufacturing. So you get near standstill, but the little sliver of growth that you do get is a narrower one than economists expected. Now we get the service sector number, and the real question is, do you get the same thing here as you do from the S&P Global version? And if that carries over into this, then the question about growth returns. The motivation behind this sell-off to begin with is very much back in focus. Because it isn't about tariffs on or tariffs off. It's about, does the U.S. service sector continue to power the economy? Looking at the U.S. Economic Surprise Index from Citigroup, we see that since about the middle of November, U.S. economic data started to deteriorate relative to expectations, and most recently has actually dropped below this zero center line to suggest that now U.S. economic data tends toward undershooting relative to consensus forecasts, which seems to bolster the idea that this is going to be a disappointing outcome, or at least the chance that it is. It skews risk of a surprise in that direction. So what happens if, in fact, this is a disappointing number? Well, as we just said, we again learn that the problem here isn't about what is happening with the tariffs as such. It is with the unraveling of service sector business confidence and consumer confidence alongside. So if we get a disappointing number, then perhaps the broader sell-off in equities resumes after today's back and forth. Moreover, we can see that the implications of these growth concerns have been to price in a more dramatic rate cut cycle from the Fed. You can see that in this dovish adjustment in policy expectations, both for this year and for next year. 68 basis points in cuts on the menu now for this year. That's 2 with a chance of 3, and 1 on the menu for next year for 93 basis points in total, almost in line, by the way, with the Fed's own forecasting of 100 basis points done in December. You get a weak ISM number, and this is going to get endorsed and perhaps see a further dovish shift, which might suggest beyond stocks falling that bonds, after getting stalled here at the early December highs, might continue to power higher as yields fall. And of course, the other way that you suspect that this is not about the tariffs, but more about sentiment, is what happens with the dollar. The dollar gets crushed today, despite having rallied on tariff news before. You can see the euro here surging out of its congestive range and seemingly setting the stage for further upside. And that's because this is about the U.S. having a growth scare and maybe more rate cuts, which then means yield differentials shift against the dollar. Reiterating that this is probably a growth concern, not a tariff story in isolation. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris Mondays and Fridays for Futures Power Hour, on with Victor Jones in a mere 30 minutes from now, as I am every Tuesday, for The Price of Truth. Back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Price of Truth in 30 minutes. See you then.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily, covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
What is going on, everybody, and welcome back to today's segment. We are back with Gus, talk about this market volatility we've been having, talk about some positions, do a little tour to market, and just get into it. But what's going on, Gus? How are we doing today?
I'm doing well. Having a bit of a bad hair day here. We did some shooting for the new merch line earlier today. And part of that required me to wear a hoodie backwards with the hood over my face. And as such, my hair got a bit unrecoverably messed up in that exchange. But outside of that, feeling good. Quite the day on the market. This volatility that we're getting is so much fun. And I do say that seriously. Yeah. I realize that might have sounded sarcastic. I am serious. It's fun having this kind of vol and constant opportunities arising every single day. So yeah, it's been a good one for me. Lots of repositioning, and I am down, but yeah, you're only down. You're not down unless you exit. So that's where I'm at on that one.
No, I hear you. No, honestly, not a bad hair day, Gus. Mine's been a little nappy lately, but outside of that, the markets have been well. I mean, the volatility is fun. It did come off a little sarcastic, but I mean, I guess it just depends on who you're asking. But we do have a vol trading above 25 momentarily today, and then we pulled back a little bit. But we'll get into all of that. I know we have a lot of excuse me. I know we have a lot of tariff news that's getting finalized, and just an overall shifted market sentiment. I feel like that's kind of what we touched on last time, but it seemed like we continued onto that in the beginning of this week on Monday. We're getting a little bit of a relief pop in the market now,
But you got any thoughts on this? Anything you're looking forward to heading into the week, and then we'll get into some of our positions.
Yeah, we just keep doing this thing where it's panic for the first half of the day, and then around lunchtime we start to recover, and we're pretty much completely back out of it, and it's been weird.
Yeah.
But yeah, I spent my day today loading lots of shares, and then also some leaps. I think the shortest position I have open right now is like 60 DTE. But I am.
What is that in?
That is in. I actually tailed that from Cherry Picks, which you guys should subscribe to if you're not already. That would be. Let's see. I have this IWM NVIDIA. I have some NVIDIA April 17th. NVIDIA. So that's 44 days to expiration.
I got you. I know we had earnings in that. What it was last week? I think it was. We didn't really go anywhere.
Yeah, it came down a bit off those earnings, but it's all in the rearview mirror now. Every day just presents its own whole slew of headlines here. But I sold April 17th 100 put, and then I bought the 90 on that one. Shout out Nick for that trade idea.
Yeah.
But yeah, obviously expecting a bounce in the longer term. And I'm not really trying to time this one up. That's why all of my positions are so long to expiration, and why I've been high on buying shares today is because I'm not exactly sure how long this little, breathing period is going to last, and how much more we might come down before things turn over. So I'm just giving everything 100 days. I think it would be incredibly surprising if we continue downward for any longer than that. We'd be getting into recession territory at that point. So that's where I'm at. But this week, looking to buy is my thing. I'm loading shares and waiting for the recovery. I will be a rich man.
I know. No, I hear you. And I know you kind of tagging along with NVIDIA. I'm looking at SMCI. This one's one that's kind of been on the radar even from last week, I think, when NVIDIA was having its earnings, and just kind of waiting post earnings to see how the market is going to digest all of the news. But this one's looking a little attractive here, Gus. I have to say, you bringing up NVIDIA just always reminds me of SMCI. So I'm curious to see what these premiums.
Yeah, they had 166. It was funny. Two of the top 3 earners today have micro in the name. MicroStrategy also up there. But yeah, SMCI, it is an interesting prospect. I just still don't know if I'm all the way there with this company. I know that they have gotten over these regulatory hurdles, and they got a pop because they managed to keep from being delisted, which is the funniest thing to say. But yeah, I don't know if I'm a legit believer yet. I feel similarly about SMCI as I do Palantir, though Palantir has not been subject to the same scrutiny.
Palantir, another good one. Palantir, first underlying that I traded options with, but I don't know. I know SMCI, something like that would be kind of more so just following suit depending on whatever NVIDIA is doing. But SMCI, this was one that caught a little bit of steam over the last few weeks into the end of the year this year that I did not see coming. It would be classified as a sleeper build, if you will, if you spoke with Julia about those. But PLTR caught me off guard. And what's going on, Lone? Just getting back to the chat here.
Yeah, you said your first trade ever was Palantir?
First trade ever was Palantir, and what is it? I know. No, it wasn't Taiwan Semiconductors. It was Palantir. It was 2 underlyings. Palantir was one of them. I don't even remember what the outcome of that was, but that was on the Where Do I Start series when I knew completely nothing about the market. But Palantir was one of those sleepers. Like, even just in 2021, it was one of those underlyings everybody was kind of talking about, like maybe has some potential, whatever the case is. So it's kind of funny seeing it a few years later, really catching steam like this and hitting some type of parabolic type moves.
Yeah, I'll throw around another Julia term. She likes to call that a Peloton curve.
A Peloton curve.
A Peloton curve.
That was around Piton.
Yeah, Piton.
That was around the same time. Yeah, when Peloton was going crazy. I think it was excuse me, in the COVID days, right? Because it was whenever the exercise machines were really popping off. That was around the same time of Palantir. When I was getting into Palantir was super hyped up. But
I also started trading during COVID, but my first trade was Apple. I'm a normie. It was naked Apple calls, and I made like 120%, and I was hooked from there. But yeah, Palantir, that's a wild one to start with.
I was looking at Apple earlier today. I really like the IV rank in Apple. There's no earnings or dividends to worry about right now, but I ended up going with Meta. But it's funny you bring up Apple. Was checking that out. Premiums are decent on it, nothing too crazy, but I ended up going with Meta. So I sold an out of the money put spread on Meta, kind of break even on that right now. Just put that one on today, so we got to see how that one plays out. But it is a longer dated one, 44 days till expiration. Decent IV rank, 37.2 IV rank. We do have earnings April 23rd, but I am in the 44 days cycle. So, excuse me, I should be able to manage this one before we even get to April 17th, because we'll be managing around 21 days. I was able to collect about $1.78, so just a little bit above a third of the width of the strikes. And then just because we've sold off so much in just the overall market as well, the NASDAQ, I wanted to get long on some of these names and take advantage of that short-term volatility that we're getting, especially with VIX popping above 25. I'm really going to try and take advantage of that, because I didn't recognize how spoiled we were when the market was always, or when VIX was always trading above 25. So first time today, it broke above 25 since I think it was the first time this year. I don't think we've had VIX above there since, but that really is what nudged me to get into some of these underlyings. Looking at Apple, but again, just ended up going with Meta.
I was able to close my VIX. I mentioned I opened a long VIX position last Thursday, and I did get out of that for max profit today. So I was certainly pleased with that.
That was that vertical. You bought that vertical, right?
Mm-hmm. Yes.
Nice.
So that panned out very nicely. I just needed above 16, so flying colors on that one.
Yeah.
But yeah, I agree with you. It's good to try to take advantage of that short-term volatility. All of these leaps that I have set up here are structured in such a way that I can harvest some of this data, because all these premiums were juiced to high hell today. And yeah, on days like that, lots of great opportunities do present themselves. I was sitting here about to say, I think I only have 2 options positions open, and I have 6. So I was slightly off. I did all kinds of tomfoolery today, just lots and lots of repositioning. Between me and you, we are in like a lot of the Mag 7, because I loaded some Amazon and some Google today as well. Did get out of my Amazon vertical position that I had mentioned. That was finally dead. So picked up some shares. I've gotten $20, $30 back on that one today on my 5 shares. So can't complain. Really. Another day where I accidentally timed the bottom pretty well, at least the intraday bottom. I don't think we've necessarily found the bottom yet. But yeah, I mean, it's just, I don't know. This is just a really pretty basic portfolio. I feel like I'm long IWM, I'm long Qs. I got that NVIDIA trade, as I mentioned. And then I went long some Berk B. I picked up 4 shares, then also picked up a vertical there. Because
long IWM, this one's Berk's B's, or what was it?
Yeah, on Berkshire. Yeah, just on Berk B.
Right. Berk.
But I think I have a theory that Berkshire is going to be able to recover faster than the rest of the market. They've been holding that cash pile forever. They still have, I think, $325 billion in cash or something like that, just laying around. So with all of that uninvested capital, I feel like now is the time when they're going to start attacking and getting a bit more aggressive whenever they think that we've found the bottom. And I do expect them to be able to recover a bit quicker than the rest of the market. So I'm slightly shorter term.
I got you. You were looking at IWM and QQQ as well. Got long those. Was that after the aggressive sell-off we've seen over the last week?
Yes, today. Pretty much everything I just said. In fact, yes, everything I just said was open today. Qs, IWM, NVIDIA, and Berk B.
No, I hear you. NVIDIA, in terms of NVIDIA, I got in a position as well. So this is one of the last ones. I bought an out of the money call. I think it was, last Friday? That did not pan out. I ended up cutting that one. But that leg down that we got on Monday caught me off guard. I didn't expect that, especially after the day that we saw on Friday. But today, right before the bell, I ended up getting long some more Qs. So these ones are for the weeklies. I sold the 490s I sold the 490 puts on QQQ, and then I also have the 505s, the 505 puts sold on QQQ as well. And then for the 44 days till expiration, I have the 490s sold. So we have a little bit of credit in there, a total of 478 of credit wrapped into all of those trades. So gonna see how these ones pan out. I know last week, Gus, I was in a little bit of a pickle when we were talking about my weekly QQQ I think it was a put spread that I put on. Excuse me. And at the last minute, let me just go back to last Friday. I wanted to show you this because I was able to come out a little bit, not near break even, but I was down about $60, $70 on that trade, coming back from a max loss on it. But I just want to show you real quick how we closed last Friday. But QQQ has really been the play for myself the last couple of weeks with all the volatility we've been getting. We'll see if I can even find this. We'll see if I can even find this.
The time
but
frames
it was just one of those. No, I know. Last Friday, I think we had a rally into the close last Friday, and we got so close to my break even on the trade. So I know we were going to come back around to see what the outcome of that was, but we'll save it for another time. But I do have that QQQ put spread on. I have 2 put spreads that expire this week, and then I have another put spread that expires in about 44 days. So that's what we did today. Was looking at Apple too, was looking at Tesla. That was another one I was keeping an eye on, but I don't know. Tesla's just too volatile for me right now, which is all the uncertainty with Elon Musk being so involved in a lot of areas that wasn't previously involved in. It's just like even more volatility to deal with. So I was like, you know what? I'm going to focus on these volatile indices that I have right here, maybe some Meta, maybe some Apple, but Tesla is a little too sporadic for me at the moment. But
yeah,
check it out.
You know my thoughts on Tesla. Tesla.
Oh, that's on the no trade list for you, isn't it?
Yes, the no trade list, which is getting ever shorter. But we'll see if I'm ever willing to overcome my trauma and trade Tesla again. I don't know that I will be able to. But yeah, it's just. I agree. I mean, it's just got so much volatility. It had so much volatility before. Tesla has been turning boys to men for some time. And now, yeah, with the additional government involvement with Elon, the way that all these different government headlines can have a direct impact on this share price, it's just scary. And I do feel like it's oversold, but I'm not there. I can't bring myself to do it.
No, I mean, I'm probably not going to touch this one, but after everything just going on with the tariff news, I think we even doubled the tariffs on Canada. So it's just like those random kind of new pieces of information that kind of makes me want to stay away from Tesla just for the time being, at least. But other than that, that's what we got in the portfolio. We'll see what we're going to be looking at for the rest of this week. Been keeping an eye on energy. Oil is one that I kind of stay away from. I think we got your thoughts on oil last time, but I've been looking at /CL, /MCO for the micro futures on oil, and then been looking at USO as another product to trade oil through as well.
Yeah, it's interesting. Yeah, I'm not an oil trader myself. I as I've said before, I respect it. USO, interesting spot for it.
Yeah, I mean, oil is just one of those very sporadic ones, very affected by those headlines, the supply and demand headlines. So, I mean, I've just been taking a look at that, looking at USO, and then lastly, been looking at things like Bitcoin with the news that came out over the weekend about it becoming one of the world's reserves. It was another like hype piece about Bitcoin, and we got that massive sell-off. You got any thoughts on that? Do you have any thoughts on the whole recent situation with Bitcoin before we move on here from oil?
Yeah, I think it's interesting. I'm surprised. I don't know. I'm not surprised by the crypto reserve announcement, and frankly, I was surprised to see Bitcoin take as much of a bounce as it did on that news. It felt like that should have been a little bit more priced in. You know, the Solanas and Cardanos and XRPs of the world. I can understand the rocket ship that they went on. But I was surprised that the market wasn't more efficient with having the eventuality of this crypto reserve being formed. I mean, Trump has been shouting this from the rooftops for some time. This isn't, some crazy shock. So in turn, I was not super surprised to see a little bit of a correctionary move. But it has just been so wild watching Bitcoin race back and forth. I had bad timing a week or two ago. I got long some IBIT, and it was right before the big drop. I did on yesterday morning, I did manage to close my IBIT longs just for not max loss, which was a win to me because they were sitting at max loss, unable to be liquidated for like 5 days. And it managed to recover to where I was able to liquidate. So
what was the expiration on those ones?
I think it was next Friday, a week from, or this coming Friday, I should say. Yeah, a week from this past Friday. Wasn't seeing a lot of hope. I needed a ridiculous move out of IBIT. I can't remember exactly what my strikes were. Let me have a look. I needed it over 54.5 Where are we at? 49.39. Yeah. So I think I made the right call on that
49.39.
But I don't know. It's been really interesting to follow. I don't know if you saw. Did you see the guy who did the 50x leverage on a $4 million Bitcoin trade on Sunday?
50x leverage on a $4 million Bitcoin trade. No, I didn't. What was that about? Where was he on? Was he on Reddit again? What was that?
Yeah, it was a big story. I saw it from a few different mainstream news outlets. He was trading on, I don't remember the platform, Hyper Liquidity or something like that. It's a newer one. But yeah, this guy took 50x leverage on $4 million of long Bitcoin, and he could only tolerate a 1.3% move to the downside before he was going to get liquidated. And it got within $50 of liquidation, and then Trump said the reserve stuff, and it rocketed, and he made
$50 of liquidation. Wow.
Yeah, it was like Bitcoin itself was $50 away from him getting liquidated, and then it shot up 11%. He made $7 million.
Well, I'm curious, was there speculation about him saying something about or speaking on crypto? Was there speculation of that beforehand, or?
Oh no, I'm not going to make any accusations, but it seems a little bit suspect. It's all I'll throw around on that one. But yeah, $7 million. Leverage crypto, oh my gosh, it scares me so bad. I don't know how anybody does it. It's so wild to me. I had a friend who was playing around with it for a little while.
What do you mean crypto?
In leverage crypto is what I'm talking about specifically. I mean, leverage products in general, but specifically leverage crypto because you can get 20, 40, 50x leverage on these things. And that's just insane to me. There's enough risk the way I trade now. I don't need to 50x my risk. I'm good with the amount of risk I got.
Not only that, 50x the risk, and then also, your timing has to be, down pretty well.
Yeah,
immaculate. Yeah, absolutely immaculate. I think it just makes it it gives you an even smaller window that you're working with.
Well, yeah, exactly.
But anyways,
if you can only tolerate a 1.3% move down on Bitcoin, a notoriously volatile product, it's like that's crazy to me.
Yeah, no, I mean, just like Sub-Zero saying over here, he'll probably do it. He'll probably do it again. I mean, you're getting rewarded. That's the thing about the market. That's what's crazy is you can get rewarded for doing, having bad habits. And the way we're driven, we're going to be more likely to do it again. So, maybe Bitcoin, maybe he hits next again on Bitcoin, right?
It's true.
So don't listen to me, man. Don't listen to me.
Yeah, it's still anonymous. Nobody knows who it is. It's all just people spotted on the blockchain. But yeah. Crypto.
No,
crypto
I hear you. I'm just taking a look at IBIT here. I haven't traded IBIT before, but because the overall crypto market has gotten a lot more volatile, it makes it a little bit more interesting. No earnings or anything like that to worry about, so that's nice. Iron Condor, decent amount of credit. Excuse me. The pop on Iron Condors are never too attractive, but it's an Iron Condor. $260 worth of credit. $5 wide worth of risk, not bad. Looking to get long, if anything. But then again, that's where I have to watch myself too, because when vol expands, I think, okay, I want to get on some more positions. Let me, sell some out of the money call spreads here, or I'm sorry, some out of the money put spreads. And then I'm sitting with a bunch of this long delta because everything is selling off so much that I'm overexposing myself to the downside just a little bit too much. So something for me to at least keep an eye on. But I'll look at IBIT as well. Put that on the watch list. We'll build that out.
Yeah, for sure. Yeah, I've been long delta against this entire move, and it has been brutal. And today I got out of everything except shares in the morning, and here I am again. I'm just back super long delta. So yeah, I mean. And it's not just like some brain dead, the market's got to go up sometime sort of take, even though it kind of is. And that's especially where I'm at with the shares is that I know that recovery is unavoidable. I mean, in the macro context.
Yeah. I mean,
so yeah, I have fewer plays where I'm trying to time things up. But I mean, like what did SPY close at today? We're 576.
SPY closed. Yeah, we had a little bit of a bounce into the close. I mean, we sold off about 36 minutes before the close. We had a pretty aggressive sell-off, and then we bounced into the after hours briefly.
Yeah, and we were at 600 a week ago. if that, it's so crazy how parabolic this move has been. So I certainly think that there could be more downside left. But this has been a pretty hardy correction to this point. And I think that the end, at least in the micro, is somewhat in sight. I think we're due for at least a great week. shoot, at least
I mean, I hope
before we
so.
go ready.
I was really tempted to just buy a futures contract with just one micro, let it sit there until we recover. But I'm just like, if we somehow gap down 200, I'm just not going to be okay with that. So I was like, you know what? I'm going to sell an out of the money call spread on QQQ, and that's why we went that. But I was so tempted to just buy a future and let it hold and let us recover a little bit. But I don't know, the sell off over the last few days. I mean, we've been down almost 1,000 points on NASDAQ.
Yeah, we have there's a Trump speech tonight as well, which is kind of a State
What
of the
time
Union.
is that at?
I'm not sure. 7 Central, I think. 6 Central.
Yeah.
But it's not a State of the Union, but he is addressing Congress, and like the, event markets of the world are calling it a State of the Union, even though it's not. I don't really understand what's going on, but big things coming from Trump tonight. So that did make me even a little hesitant to get into these positions today. But I decided that these are all long enough term that the upside reward is too good to ignore for the downside risk, because it's equally likely that he says something that sends SPY down another $10 or up another $10, and we really have no way of knowing. So I didn't want to miss the bus should we get the latter.
No, I hear you. That's another reason why I've just been trying to take advantage of those, selling those put spreads, not trying to have to time it as much. But I mean, we're absolutely beaten down on NASDAQ. So tomorrow, if we make more lows, best believe I'm selling more out of the money QQQ put spreads. I wish I had more on. I wish I had even a longer duration one on too. But I mean, if we keep heading lower from here in this short amount of time, it's only going to make me want to sell more out of the money puts, as long as I have a decent time window that I'm working with. But we'll keep an eye on it.
Yeah, no, I mean, I agree. I just agree. It's getting increasingly more tempting. I've left myself with plenty of buying power should I need to average down or do any management moving forward. But I'm comfortable. I'm comfortable being as long delta as I am. I mean, even against this market, good things. It's not just good things have got to come sometime, but the market recovers. The market by nature wants to recover. And so if you position yourself for that recovery in the longer term, I see it as highly improbable that I don't win on at least a majority of these trades, especially the shares, which have already done some printing for me as it is.
You reminded me of Luis. Luis was always just coming with some like random shares and all these underlyings. I was like, Luis is a share guy. But that reminds me, I just want to check out Netflix. Whenever I think of shares in Netflix, I think of Luis.
If you
and
have the capital,
let's just check that out before we wrap.
Yeah, if you have the capital, shares are just a good way to do it. Why try to time it if you don't have to? Plus, you don't have to calculate any break evens. my break even is my entry.
When I was first getting into options, the one thing that was so difficult to do was managing my risk getting into it, because I was like, well, if I have a stock and it's just a share, I buy at $5, I sell at $4, I lose $1. The math was like so simple, but that was just a lack of knowledge. But Netflix is doing well though. I just had to check it out real quick. I don't watch too much streaming services, but Netflix raising their prices, so we'll see what we get there.
Yeah, I'm a YouTube guy. I haven't watched a show in a little while.
You know what I just started paying for?
What?
I just started paying for, is it the YouTube Premium or YouTube Red? What's the difference? I know there's two different services that you can get.
I'm not sure. I have Premium as well, and I love it. I highly endorse YouTube Premium if you're a daily YouTube user. It's awesome. Yeah, you get rid of all the ads. And also being able to watch stuff with your lock screen on, that's so nice. Yeah, you can lock your phone.
So nice. Sometimes I'll listen to a podcast when I'm in the gym or I'm listening to something like that. And I used to have to always flip the screen to where it's not touching my thigh when I put it in my pocket, because then it will like change whatever is on my phone. And now I can just lock the screen.
Yeah.
Listen to whatever is on there. So that was a W by Google and YouTube. So I'll give them that. Such a small detail just to make it a little bit more convenient and so much worth it.
Yeah, it's just great job of listening to feedback from users and implementing it. And I'm happy to pay for it. I'm happy to pay for just the no ads, and that feature are worth the price.
The ads is an understatement. Those are commercials.
Oh, yeah.
I mean, these are full-on commercials now.
They're getting longer and longer, and you're getting the back-to-back unskippables and all that. I've had Premium so long, I've never had the double ads before in my life. I just see everybody bitching about it on Twitter.
The back-to-back unskippable is absolutely devious work. Back-to-back unskippable.
Yeah, and you'll get them
crazy.
like mid-roll too. It's crazy.
Yeah. But no, Gus, anything to add before we hop on out of here today?
No, I got nothing. Just getting long. I'm not afraid to be long delta against this market. We got to recover.
Yeah. We'll see what we get. Put on some more long delta today as well, so we'll manage that for the rest of the week. But that's going to do it for today. Thanks for joining us, and we'll catch you guys next time. Peace.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
tastytrade has crypto, and you can trade with 0 commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
I'm running Snow Leopard with this. I'm a Mac. I'm a Mac. I'm a Mac. Gee. Multitask, MacBook handler, brother. iPhone in one hand, iPad in the other. Pop open top, Apple logo shining on the back. That's why all these player haters know that I'm the Mac. Easier to see a nun with VD than to see me ever typing on a PC. So if you got one, you can play a sad tune and play it back later in your room on your Zune. Windows made to break, and I'm here to crack it. And if I'm a Mac, that means that I'm immaculate. Style so clean, like it's disinfected. Clean surfaces where white light is reflected. Plastic case, Apple Store, keep my phone protected. Check my toolbar to see if networks are detected. Use my side swipe, applications hidden in it. This is Mac world, bitch, you're just living in it. I'm a Mac. 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 Roll into the coffee shop, know I'm on a power trip. Strapped with my laptop and my own power strip. Eye outlet, about to make your cable drop. Apple logo shining off the marble on the tabletop. So if you see me, then you see a star. Any place I sit down, call that the Genius Bar. Looks like I'm working hard, but to really know the truth, just taking pictures of my fine self in photo booth. Interface simple, why I need a Kindle. Working on that pad keeps my fingers mad nimble. So if you think I come up short, you must be wrong. More than one reason that these ladies call me Justin Long. I'm a Mac. I'm a Mac. I'm a Mac. Yeah, Justin Long, son. You catch that? Known by the ladies as the toolbar. 10-hour battery life. Force. Quiz.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but 2 trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a tastytrade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at tastytrade. Make your move, genius. tastytrade.
Don't die.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Oh, yeah. Tasty Nation, good morning.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Oh, yeah, it is Tuesday, March 4th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's Evening Show, a little podcast. A little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world, and good God, are they throwing incentives at us like Tic Tacs. But no worries. Before we get started, we should say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile application. If you don't have both, go get them. But if you want to be part of the conversation that you will see on your screen, bing, right here. Did it work? Did we time it up? All right. If you want to be part of the conversation, there we go. That will be part of on your screen. You got to do that. You got to head on over to evil Google YouTubes and type in whatever you want, really. Just type in nonsense, random ass characters related to the conversation or unrelated. Just as long as you're being active, we can spoof the Google algorithm and putting us in front of as many people as possible and deprogramming the world one view at a time. It is Tuesday, my friends, which means I brought the big brain in. I'm talking, of course, the global head of macro here at Tasty Live, none other than Ilya Spivak. Ilya, how you doing, my friend?
I love days like today. I love it because there's so much for people that care about the stuff I care about to think about and consider. there's so much market action around those things, and that market action is happening around a macro narrative, around macro forces, that macro forces are in charge here of these markets. That, of course, is exactly the kind of pool that I like to swim in.
Hey, listen, man. Around here, we do a little something called cold open, okay? In your show, you might get straight to the wham, bam, thank you, man. But around here, we do a little bit of foreplay, okay? And the foreplay is nonsensical talk to open up the show that has nothing to do with markets. And the nonsensical talk I want to talk about today is aches and pains. They don't tell you when you're a young man, Ilya Spivak, that they tell you when you get older, you might slow down. You might not be as strong. You might not be as fast. But they don't tell you everything hurts. They don't tell you, it's just like nothing works and everything hurts. They don't tell you that part, Ilya Spivak. And I think if they would have told me that in like PE class or gym class when I was in 5th grade, I think I wouldn't have taken it for granted as much as I did. You know what I mean? Because now just give me 10 years ago. Give me my body, my ligaments and my tendons from 10 years ago, and I'll be doing okay. But right now, everything hurts, Ilya.
I will say this. I definitely did not anticipate the degree to which every single day after a certain age is a little achy, a lot underslept, and slightly undercaffeinated, no matter how much coffee has been had.
Well, I don't do the caffeine, but I do. You know what this is? This is a little something called Tiger Balm. There's white and there's red. Okay, so white is not the extra strength. Red is the extra strength. They don't tell you you're just going to be lathering yourself in Tiger Balm every time you wake up in the morning. They don't tell you that. They don't tell you you're going to walk around smelling like medicated ointment. They didn't tell me that, man. But I do.
They don't tell you Tiger Balm exists unless, like some of us, you're familiar with the far East Coast. In Russia, Tiger Balm is very well known, and in my earlier years covering Asia markets, I've come to know and love it dearly.
Yeah, good God, man. You know, when you're a young kid, you think, maybe what kind of cologne should I buy? You're putting on fragrance for the first time. Maybe you're going to a homecoming or a prom dance. No. When you get older, that's not. You smell like medicated ointment. That's what you smell like as an older gentleman.
Responsibility and experience is what you smell like. Your demographic has changed.
Smell like responsibility. That was a bar. All right. See, that's what I'm good. That's what you do to open a show, bro. Then you go into all the ridiculousness. All right, S&P 500, 5833.50. We put them to a test, man. We had said on this show, 5800. We're gonna press them. Yeah. We got there, and the question was, would they hold? And for a day, anyway. They held them, traded up off the lows, and in extended hours, they've pushed up even further. But Ilya Spivak, tell me what you think about price action, the little rubber band action we saw around 5,800. Do you think this is basically sort of a feeble last stand to hold the market up here at this area of resistance? Do you ultimately think that we rotate and find a new range that is with 5,800 being new resistance? What do you think happens here? How are you playing this?
Yeah, I mean, I think if you thought that the holding of this range, narrowly though we did in some places more than others, I would say S&P more than NASDAQ, let's say, the narrowing holding of this range is a trap. If you think that this is a buy the dip kind of opportunity, I think that's a trap. I think we end up lower from here. I think this is not the end of the sell-off. I think this is the beginning of it. And this is the sort of cumulative coming together of all of those things we've been talking about. I also think that the intraday seesaw, given what we've been talking about, really makes a lot of sense. At the risk of being a little bit long-winded, I'm going to break this down and
Ilya? No.
No. and extrapolate. So why did the markets fall out of bed? Ostensibly because the tariffs that were on ice since February were no longer on ice and got actually implemented. Canada got hit. Mexico got hit. China got hit with another 10% on top of the ones that we got a month ago. Everybody immediately announced some form of retaliation, or in Mexico's case, an intent to retaliate.
Mm-hmm.
Markets looked and said, well, a trade war where everybody is competitively attacking each other isn't good for global commerce. That's bad for growth. We've been worried about growth for weeks now, ever since U.S. data started to turn. Okay, that's bad. Clearly, stocks down, risk off. Then midday, you got a little bit of a seesaw. And in my mind, that seesaw makes sense if you look and say, well, if the threat to growth is tariffs, how afraid am I? U.S. growth has been powered by services. In fact, the reason that U.S. resilience hasn't spilled over to other parts of the global economy is mainly what the U.S. imports are goods. And they've been anemic. That demand has been basically stalled since COVID. Demand is being driven by services. That demand is serviced mainly by domestic firms. Okay, yeah, fine, we'll get some tariffs. Are they going to really hurt the U.S. service sector growth directly? Maybe not. Are they going to hurt the growth of the other countries that we're targeting? Yeah, because they depend on exporting goods to the U.S. So maybe this whole thing will be short-lived. It'll leave the engine of U.S. growth mainly intact, and we'll get a renegotiation of the USMCA, which expires next year, as an end result. Because, of course, that's exactly what happened when in the first Trump administration they ripped up NAFTA, only to come up with USMCA, which is almost exactly the same, but for a little extra chapter on digital markets. Other than that, it's almost exactly NAFTA. So maybe that's what this is. And there is a seesaw. But then, and this is the part that I think is the lasting bit, you are reminded that the reason we're freaked out about growth in the first order is that PMI data on February the 21st that tells us we got the first contraction in the service sector in 25 months. So if you think that the tariffs aren't a big deal because it's a goods side story and not a service sector story, okay, fine, the tariffs don't hurt, but they don't help. And the situation on the service side isn't even about the tariffs. That's not why we're concerned. The tariffs are just another thing. The trade war headlines are really just a distraction. The issue that faces growth is in the service sector already. And it is reading the, let's call it, the cumulative assessment of the situation now from S&P Global, from the Conference Board, from the University of Michigan, from a whole host of these survey-type entities that poll consumers and businesses. It's not that they're calling a referendum on current policies being bad. It's that they're getting shaken by the volatility of the policy. And there's uncertainty. And they just don't want to lay out more money until the uncertainty settles. That's the essence of the growth concern. So I don't think that this seesaw today changes anything. I don't think anything is fixed or necessarily worse or better. I think we get the ISM service sector numbers tomorrow. They show us something very similar to what the S&P Global numbers did that spooked us, and we're right back into a sell-off.
A couple of things. Let's just set the table here. S&P 500 obviously was lower on the day by 1.25%. The Nasdaq was down 1/3%, which I find interesting. Sort of slowed momentum on sell-off in tech here today. The Dow Jones down 1.5%. I find that interesting as well. That's sort of the low beta blue chip dividend paying stocks down 1.5%.
What I'm talking about. here. The NASDAQ was the best held up, and it's because that service sector demand, that's where it lives.
I also think that's the NASDAQ, a lot of those stocks, like NVIDIA, just got punched in the mouth, man. At some point, you're like, I'm taking a stab at NVIDIA at 114. The Russell down 1%. I also found it interesting today, and I wonder if you could speak to this a little bit. The long end of the curve, so everything in terms of interest rates, the long end of the curve moved higher today. We moved higher across the curve, but the long end of the curve really had a decent move to the upside. I mean, we were at 119 almost and a half. End of the day at 117 and 25, 30 seconds. If I show you a picture here, we can see we started to move a little bit higher. The long end of the curve steepened up just a little bit. I'm curious it wasn't massive. It wasn't a massive move, but I am curious. We've been seeing buying in the long end of the curve. We've been sort of seeing in the last 5 or 6 sessions, we've been seeing a more traditional risk off as markets have been lightening up. But today had a very different complexion. As we got near 5,800, you saw VIX term structure that went in full backwardation today. You saw them starting to sell the longer end of the curve. It didn't feel, today's market action didn't look like the last 5 or 6 days. And I'm curious to get your read on why you think that was the case.
I think if you consider that the tariff headlines made such a big splash in markets today, it's not difficult to see that markets basically said, okay, well, if there are these tariffs, then they're going to get passed through from businesses to consumers. There's going to be some inflationary uplift from them for some amount of time. And then things will normalize and the data will roll over and rebase. But for some amount of time, this will be an influence on inflation expectations. And to that end, we might have a Fed that isn't quite as dovish as we thought yesterday, when the only part of the story was concerns about growth and the Fed is going to have to cut more, both at the front end and the long end. In fact, that's been the story for a while. There was a slight rejiggering of Fed funds futures around that. So, for example, yesterday we were baking in, let's call it 65 basis points for this year. So 2 cuts with a slight chance of a third. Today it's a little bit better. So not quite as many cuts. So if yesterday, today, as I'm looking at the numbers, we settled at 66. Yesterday, we settled at 70. So about a 4 basis point wiggle toward less dovish. But that's Fed funds futures. That's overnight rates. Now extrapolate that with all of the term uplift that you get for 10 years and 30 years, and you get a little bit of a wiggle in the curve. Notice, by the way, that the 2-year, which is the most sensitive to immediate Fed policy expectations, it didn't get very far. It really was at the long end. And I think also those moves didn't really stick. So if you look at, for example, the daily candle on ZB, you look at the daily candle on ZN, it's a bit wacky. We get bonds going a lot higher, and then not, and then seesawing back in.
Dude, you're you are the most hilarious markets commentator I've ever heard. Your depth of knowledge is unparalleled, and then you couple it with just the word choice. So it tickles me, bro. The daily candle. I am wacky.
I am a reader of The Economist, and so I have a lot of appreciation for not overcomplicating.
I know what you're
even as we talk about complicated things. That's my favorite thing about The Economist is you can read it and smile as you read some very kind of woolly stuff.
I don't know, bro. To me, you might be right. I'm not saying anything you're saying is wrong in any way, shape, or form. But to me, I look at the implied cuts a little bit more simply than you do, just because it's easier math for me. I just go over here to the Fed Watch tool, and really, you're talking like a move in 4 or 5 basis points. That's just shifting in probabilities a little bit. But really, the picture hasn't changed. Still starting the cutting cycle in June, then September, then December. That third cut sort of snuck in there over the last couple of days. And then again, this is a 5-year. I could pull up any inflation expectation, chart, and they all say the same thing, that for all the tariffs or inflationary discussion, and like that's not the market does. That's not what the market is worried about. The market is not worried about inflation right now, and in fact, inflation expectations for the most part across multiple time frames, they're on the floor, and this is the problem. And
so of course this is the problem, but inflation expectations, I wouldn't say are on the floor. If you look at break-even rates, because inflation expectations relative to September, if you look at break-even rates, be it the 5-year or the 10-year, are meaningfully higher. So it really depends what you look at. But what we definitely saw, right, just what certainly occurred between the Fed being really dovish in September and them becoming less dovish by December, is there was some level of, and here you go, you can see it on the chart here from the second half of last year, inflation expectations go up. So you definitely see the markets go, the Fed was too dovish, it's going to have to get less dovish because all of this is inflationary. And then in December, the Fed confirms. It dilutes rate cut expectations. Over that period, the dollar goes up, yields go up, bonds come down. So inflation expectations were very much a motivating factor, let's call it the fourth quarter of last year, and it was to the upside of inflation. Now, that's been within, as you can see here from the 10-year, a range that's persistent. But it was on the way higher, and they've weakened a bit since. But when you look at the 5-year, it's more extrapolated. 10-year is more anchored, of course, because it's longer term.
So let's use this number then versus the 5-year 5-year. Let's use your 10-year break-even inflation rate.
Sure.
If you're telling me that inflation expectations are near 2.5%, let's use 2.4 to 2.5%, and growth expectations, and if we use Atlanta GDP now, or on the floor. I mean, I know an economist is going to say, oh, no, that's not stagflation because you got to have an unemployment component of this. But my simple bird brain says growth on the floor, inflation up, that's a stagflationary conditions. Why shouldn't I be pulling out the stagflation playbook and executing that right now, Ilya? Or maybe you agree that that's the environment we're headed.
I don't think you necessarily shouldn't. I think the difference that I would make in that assessment is not so much that what we're looking at is stagflation, quote unquote, because I think obviously it's too early to make the call. But if we wait to make the call, to make the trade, if we follow kind of the economist's textbook confirmation of stagflation, we will have missed the move by a mile because the markets are forward looking. So I think what you appreciate here isn't stagflation has arrived, because you can't make that call. It's that there is stagflation risk, and that stagflation risk is becoming elevated. And that the reason it's elevated, I couldn't possibly agree with you anymore. The issue here isn't inflation for inflation's sake. It isn't the Fed for the Fed's sake. The risk is growth. And the reason that the markets were able to be very cavalier with what the Fed would do, wouldn't do, let's say for the most part of last year, and that it isn't cavalier with it now, is that there is a growth scare. You can paper over almost anything as long as there's growth, because you have relative confidence that even if you wipe out and lose money today, there's positive growth, there's expanding earnings, you'll make money tomorrow. But if that's not the case, and this is really the essence of why I think this sell-off isn't over and why the PMIs, I think, were so ominous. If you're afraid that there may not be money tomorrow, so if you lose it today, you're not going to easily come back and roll again because you're in a generally positive environment. If the essence of the thinking, both for investors, for businesses, for consumers, starts being, I'm less confident that there's money tomorrow, so I'm going to not risk as much of the money today because I don't want to lose it and not get it back quickly, then you get a growth scare like what we're seeing. And that kind of negative sentiment can feed on itself and become a vicious circle.
I agree. And I think the question becomes, it's clearly we're headed into the part of the growth scare. We're there, right?
Yes.
Like we're there already. So then the question becomes, all right, well, how do I think about certain assets within this sort of dynamic? Clearly, equities are repricing. They're in the process of repricing. Bonds, the entirety of the curve has shifted. But the tough part here is on one end, when growth slows, you want to make a shift towards collateral, a shift towards credit. On the other end, it sort of depends on what you think the government response will be to a growth slowdown and how much money needs to be sent out to the people in order to keep them, I don't know, keep them happy or quiet. And that sort of determines how you think about bonds, how you think about the dollar. So I'm curious, Ilya. We are clearly in the middle or in the midst of a growth slowdown. Let's go asset by asset. How do you think about equities? Obviously, I know your opinion. Tell me how you think about bonds in this growth slowdown. Tell me how you think about oil. Tell me how you think about gold, and tell me how you think about the dollar, knowing that clearly people are no longer just head in the sand, growth is above trend, I don't need to worry about anything at all. That's clearly no longer the scenario.
Yes.
Walk me through it, asset by asset.
I agree with all of that. I am long the bonds. I'm doing that via a TLT call vertical. I've been long them for a little bit here again. I'll tell you exactly. I've been holding them now for about a week. So they're up a little. Once they took out that high on ZB is when I put that on. And the swing high there from early in the month. And so I have that on. I think there's a lot more repricing toward a more dovish Fed amidst this growth scare. And so I expect yields to continue to come in.
How much more dovish? I mean, they've already got 3 cuts priced in. Where do you think the market can go?
I think if you look at the makeup of the situation, the Fed told us in December 50 basis points this year, 50 basis points next year, from the perspective that there isn't a growth scare. Now, we are basically more dovish than that at this point by about half a cut for this year. But for next year, we still only have 1 cut baked in. We're not even at the Fed's line in the sand. So the markets basically think, so cumulatively 93 basis points through the end of next year. That's almost where the Fed was. We can round that off. But the sequencing is we're going to get a big splash up front here, and the next year we won't have to do as much because everything's okay. I think there's more room, and I think when you hear the Fed, for example, Powell is speaking this week on Friday after NFP, I think the Fed doesn't change its mind very quickly. It's not going to you're not going to get Powell jumping out the window and going, we've talked to you for months about being measured and not over-interpreting and over-extrapolating data points, but this is the time we're going to do it. No, I think he's going to come out and say, look, there's no need to panic. We're watching the data. If we need to act in an emergency, of course we will. If the data continues to go this way, well, we told you we're going to be easing, so you know that we already are minded in this direction. But I don't think it's going to be the kind of thing where the markets go, oh, they're convinced they're going to go big in March already. No. I think the markets are going to get the sense that the easing is coming later, and that will mean more of it has to come because there will be a degree of behind the curve action. But that's always the case. The Fed is reactive by its nature. All central banks are. And so we're going to get to a place, I think, where the long end has more to adjust, up on bonds, lower on rates. I think the dollar has started a much larger weakening phase.
Mm-hmm.
I think the euro was a really clean example of that today, but also you see it in the pound, you see it elsewhere. I've been short the dollar for a while now, and I'm going to keep holding it because I think this is just the beginning. And the essence of why I think that is, again, with the bond market. I think there's been a lot of yield advantage to the dollar because from September to December, the markets rethought Fed policy and the Fed endorsed them into a less dovish direction. So we had a dollar run. By the way, you can see it there on the screen from mid-September through the beginning of the year. The exact same run that you see in ZN, in ZB. Identical move. I think both of those things have turned. And so you get higher bonds and a weaker dollar pretty much across the board. And I'm prepared to kind of hold that, barring weirdness, strong convictions, loosely held and all, basically until the March FOMC when the Fed is going to give us new forecasts, and then we'll see.
I'm starting to turn a bit neutral on bond. I hear you, and I'm down with the dollar weakness. I think, I was, you and I were holding hands on long bonds and taking it in the, getting punched in the face as they made their move down to 110. Ended up paying off. We've had a nice 10-point rally here, but as we start to approach 120, I don't want to say I'm fully neutral, and I'm definitely not bearish, but I am approaching a more neutral position here after this 10-point rally in bonds, just for whatever that's worth. So then, what do you think about crude oil? If we're in a growth slowdown, why isn't crude oil like $60 or in the 50s?
I mean, it's certainly tried to make a run lower today. It seesawed much as we saw other assets seesaw. I think ultimately the growth scare is the reason why crude oil is down off those highs back in, let's call it start of the year. It was testing just north of 80. I was short it then and wrote it down to maybe like 70. So I've missed the last $3-4 of this move. Once it kind of started to grind into a range, I've missed the very last kind of leg through the bottom of that range there, just above the 70 mark. So at this point, I just don't want to chase it while it's in this clearly very congestive area. It's gotten stuck here for extended periods before. I'm looking for a little bit more clarity, but I do think that ultimately crude oil resolves lower. I think there's very little reason to think that it won't, because the U.S. is awash in oil. We're already hitting record output. The only reason that we're not 100% energy independent, because we're already producing more than enough crude to be fully energy independent and import nothing. Is because our refining capacity is oriented toward a different grade of crude than we make ourselves. So we export rather than being fully self-sufficient. But at this point, the U.S. is an aggregate bigger producer of petroleum things of various stages of refining altogether than Saudi and Russia combined. So
do you also think there's a floor?
You
also think there's a floor? Like at some point, if the crude oil price gets a little bit too low, then it starts to hurt U.S. oil production. You start to see some producers shut down, and I think the drill baby drill, that whole thing, it starts to be counterproductive the lower the crude oil gets at a certain point. So don't, I sort of think, I don't know where that floor is, but there's probably a floor, and when we get to that floor, we're probably going to see an announcement out of the administration that, hey, we just did some big purchase to refill the SPR, and I think once we get there, the market's going to know, oh, this is sort of the floor here. Do you think that's probably in the cards here, the lower crude oil gets?
Yeah, I just don't know where the floor is, and I know that there are more things to factor out of the price than there is to factor in. And so in the meantime, I'm happy to be short. Just I want to find a little bit of a spot here where the risk reward looks attractive or more attractive than it is here. I want to reload short while it finds the floor, because I figure any kind of geopolitical risk uplift on the price is leaving rather than growing, more likely, as time goes on. I think any disruption that we might have from the wars in the Russia-Ukraine theater or the Israel-Hamas theater never really materialized and was more hypothetical. If you looked at the spreads between the WTI benchmark and the European benchmark, the Brent crude benchmark, that spread never really ballooned out. All of those disruptions were aimed at European crude. So if there was a disruption, that spread would blow out. It didn't. So it was more like there was a degree of geopolitical risk rather than realized geopolitical disruption in the price. I think those conflicts are probably winding down at this point, both of them. And so geopolitical kind of a sort of floor from geopolitics being jumpy, I think, goes away. If growth then slows, that is another little notch that goes away until we realize that pulling out all the stops on production isn't something that's universally good. That's a notch that isn't a good source of support. So the only thing that I can really think of here as a near-term upside shock risk, obviously countries like China and India have been buying Russian oil off market for a few years and at steep discount. If there is a Russia-Ukraine deal that everybody gets cajoled into by the Trump administration, the sanctions come down and Russia has to now come back into the open market, and China and India have to buy, and in a way that's reflected and visible and transparent into the price globally, maybe there is a bit of an uplift once that demand is visible. But the markets are very good at estimating it. So I don't think, if anything, I don't think it's a lasting catalyst on the upside.
Right. And it's probably mostly discounted. All right, gold.
Exactly.
29.62. We had sort of our, we had been looking for a single 150-point day. We didn't get it. We kind of got a series of 75-point down moves in gold. So I don't know. You take what do they say? 6 of one, half dozen of another. So we ended up getting a pretty decent sell-off in gold, and for the last 2 sessions, that sell-off has been met with demand at 28.50 and higher. How are you thinking about gold? Typically, gold is a superstar in stagflationary conditions, my friend. Is there any reason for me to think about gold any differently? Obviously, it's in the price. That's why we're sitting here, arguably at 3,000 already. But how do you think about gold into the next 9 months as opposed to where we've already been?
I think you have to be really careful with assessing why gold is up here, because what you find from and by the way, I'm bullish. Let's just start off top saying my view on gold is broadly bullish. I caught the up move from the lows in mid-December all the way through about the end of January. And when in the end of January, there was that sort of weird spill, I got out. And so I missed what is maybe the second 50% of the rally from late January into the tops now into late February, where we kind of anchored. But through that whole rally from mid-December to late February, the dollar was up some, now more down some. Yields were up a lot now, but before were lower. So the typical influences for gold: yields, because it yields nothing, and so relative sort of attraction of gold oftentimes harkens back to, can you get better yields elsewhere? So does the opportunity cost make sense? So it's a foil for yields, and it's a foil for the dollar because it is a kind of physical value alternative to fiat paper currency. So if people don't like dollars, they tend to go this way. It has ignored those catalysts for any kind of a consistent lead and just started marching higher, whether the dollar was up or down in this period of time, whether the dollar, whether yields were up or down in this period of time. And I think that really comes down to the influence of China, which we saw in November started to buy for their PBOC reserve account again. So I think what the markets basically reasoned why gold had the run and why it was uninterrupted was largely because they thought that the elephant has climbed back onto the scales.
I don't disagree with you, and I don't think
tip them.
And I don't think a price is ever single factor, but I do think during that period of time where China is buying gold, U.S. Treasury yields are near 5%. So there is some reason why the Chinese think that everything has opportunity cost. Everything's a trade-off. So if I'm shifting my reserves from treasuries, which at the time I could get the most appealing price on those treasuries for I don't know how many years, and I'm in the face of that, I'm buying gold. There's sort of a reason for that, right? There's an assessment for why I would want gold over treasuries, and I think so. You're saying
I think you're absolutely right. By the way.
And you're saying, be careful about saying, we're here because the market thinks of stagflationary conditions. And I'm like, but
this is what it is.
There's a reason China's buying to begin with, which then brings us back to, I think it's because that they don't see the treasuries as that good of a deal, and they want actual hard collateral, and that's because we're headed into a period of slowing growth
and I'm going to give you
weaker dollar.
I'm going to give you a little tidbit that I think really puts this in context.
By the way, to your point, I don't really think it matters what that reason is, and I don't think we can prove ourselves to be right. So to your point, I think you are right. You should be cautious and looking at an asset and saying this is why. One, because it doesn't really matter. So that's my olive branch.
Well, there's that. But also, if you thought that gold, by the way, as is normal, as is historically the case, moves inversely of yields and inversely of the dollar, and those are its main catalysts because it is a foil for both, that didn't happen on this run. So it also didn't happen in reverse. The relationship wasn't consistent. And so you sort of start to go, okay, well, what is the X factor here? And the X factor seems to have been China. But, and this is where it gets really...
Lobo in the chat says the X factor was all the Costco preppers, which is such a hilarious joke because Costco couldn't keep gold bar. Every time they hit gold bars, they'd be instantly sold out.
Like hotcakes, baby. But this is really where things get interesting. The Gold Council just put out their latest gold market report on the 19th of last month. And they point out something absolutely fascinating. which helps to explain why gold hit a wall last month. Chinese buying is not Chinese buying. Yes, the PBOC is buying gold for their reserve account. I would argue that they're buying it because they want to build a rival to SWIFT, and they want to build a credibility mechanism for that by saying the trade flows are backed in gold. You don't have to worry about the poor convertibility of the yuan in using this settlement system. So I think that's what the PBOC is doing. But at the very same time, what you got was a outflow from Chinese gold ETFs that was almost exactly equivalent to how much the PBOC bought. And so net, was China a buyer of gold in January? Maybe not. It looks like it was kind of a scratch. Official sources bought, the ETFs shed. And so, in China. And so you got this strange thing where China was an inconsistent gorilla in the room, as it were. And so, to your point,
who are the holder of those ETFs?
It's a good question.
It's like, isn't most of the stocks in
not official.
China's like 80% retail holding?
It's not official sources. That is to say, it is unofficial market participants, i.e., not the PBOC. So, what you then look at is you say, okay, China is the X factor, you have to be careful. But ultimately, the story is yields are going down probably this year if the Fed is going to have to get more dovish around a growth scare. The dollar is going down probably. Those are the critical factors. China is various smoke and mirrors, so you do want to look at the price action and be real careful and not assume you know things. But ultimately, the bias on gold is higher. The question is just where do you, if you don't have exposure already, where do you initiate new exposure? And for me, it isn't here.
I agree with that. That's why I keep saying that little break that we had last week, it was a good start, but
yeah.
And I don't know if I don't think I did any like day trades or any short-term trades on it. It was a good start, but it's not enough of a discount to initiate new longs.
I agree.
I just keep saying the gold miners, in my personal opinion, offer the most interesting price if you want to put an incremental dollar towards the idea of gold, but you don't love the price of gold at 3,000. To me, I think whether it's Newmont or Barrick or any, point your finger at a miner here, they're significantly off their highs while gold is at all-time highs. And so I just think if that is something you want to do, I keep talking about this. I think the miners are the most interesting way to play that. And I wouldn't do it by GDX or GDXJ because I don't think they have an interesting discount. They're actually near their highs to the same extent that gold is. I would find a miner that is actually trading on discount and play it that way. So we talked about equities, we talked about bonds, we talked about crude oil, you've talked about dollar and gold. Let me do this. I want to play a little game here. It's called get Ilya's reaction. Since you've left Twitter, I know you haven't. I'm just joking. Since you've left Twitter with all your left-leaning elite liberal friends and gone over to Blue Sky, I thought I would like to bring Twitter to you. So I'm going to show you a couple of tweets here, and I want to get your reaction. The first one, both of them are quasi-politically related, but they're mostly about the market. You ready to do this?
Sure. And of course, I haven't left
I know.
I haven't left Twitter, as you mentioned. I've just spread my tentacles more broadly.
Give the people your Twitter handle real quick before we get going.
I am at Ilya Spivak everywhere. At Ilya Spivak on Blue Sky. At Ilya Spivak on Twitter, and I will post my musings on markets to any crowd that'll listen. I am absolutely shameless. I put it on my LinkedIn, everywhere.
By the way, let me ask you this question. Do you care about being politically neutral? Like, do you think in your commentary that people can tell which side you lean? And do you think it's important to try to be neutral, or do you find it's okay for you to let your bias, like to just be honest about what you believe politically? What do you think?
I think if you use your bias as a trader, you're going to lose money. Because you can't trade a political bias, you're going to get killed. So,
of course, putting that to the side, though.
Well, no, but to the extent that what we talk about is trading in markets, and what you're going to do as a participant, as a trader in those markets, I think you cannot get too political because it's not important. You have to be setting that bias aside to make your trade decisions. And to the
I agree.
Extent
That's not what I'm asking you. We do a lot of editorial here. So sure. I'm going to ask you, Ilya, do you think that people can tell which political leanings you have?
Yes. Okay. But I also think that they can tell that I am not a doctrinaire believer in this or that thing. I am what you might call radically centrist in my politics.
Okay. I think that's fair. I think that's probably true. It's a very fair self-assessment. All right, let's get going. This one, the first one is by Jem Carson. He put something out earlier that I thought was really worth. It was good context for what's happening. Sure. If you don't already understand the current White House's approach from their budget, Bessent is telling you loud and clear if you care to listen. This is what he is saying in plain English. They want to slow demand in the real economy and hence slow inflation by distributing less money to people via slowing wage growth and less social services to Americans in the medium income on down. How? A, cut government employment. B, cut Medicare. C, cut SNAP food assistance and school lunches. D, cut low-income housing assistance. Then, as these cuts take hold in the next 3 to 6 months, I think there was something a transition supposed to be here. Meanwhile, they plan to, in equal amounts, increase supply-side stimulus to get private industry moving. This will send money to the top 0.1% of the top wage earners, not increasing inflation while stimulating economic growth. How? A, massive corporate tax cuts. B, gut the IRS and corporate financial oversight and reduce taxes further. C, deregulate to allow corporations to operate untethered to increase profitability. And D, drill baby drill. The demand side policies take effect quicker than supply side. So as cyclical deflation takes hold in 6 months or so, they plan to respond quickly with loose monetary policy, switching back from QT to QE. So again, that's his assessment of what's taking place from the fiscal side, as well as how monetary policy is going to play into this massive transition, cutting demand side in their policies, increasing supply side dynamics, which will get the economy going from their perspective without increasing inflation, and also looser monetary policy to assist with that transition. Your thoughts? Is that a decent assessment of what you see happening as well? Do you agree with that?
Maybe I agree with a lot of the upshot, but I don't think that I necessarily buy into the kind of conspiratorial reasoning or like the flavor of the conspiratorial reasoning here. I think it's much simpler. I think, and by the way, I have tremendous respect for Jem Carson. I think he's an incredibly good follow and is very insightful.
Where's the conspiratorial part? I'm sorry, just so I know.
it seems like what he's saying is we're going to take away all this money from things that make the average person feel good. Medicare, SNAP assistance, low-income housing, all those things that are kind of feel-good things, and turn them into tax cuts. And that all of this I generally agree with. I just don't think it's really that complicated. I think there is a set of tax cuts that got passed in the Trump administration version 1. They're up for renewal. They want, as one of the main stays of the administration's policy agenda, to extend them or make them a permanent thing. We know that there's probably going to be a deal done internally with congressional Republicans, particularly those from high tax states, on increasing the threshold that there is to write off state and local taxes, because last time that was gutted to a significant extent. And I think Republicans from states like California, New York, and other high tax states have been groaning about it. So I think there's a deal to be done on that. But otherwise, I think the trajectory is we want to make these tax cuts extended, but better yet, permanent. But you have to pay for that, because that would be a big hit to the deficit projected out, let's say 10 years. So you do that by cutting spending elsewhere. And by the way, we already have a crazy situation fiscally. I don't think it's any kind of a threat in the near term, but I very much agree with, let's say, the assessments of people like Jay Powell that say, while we're not concerned about anything like a U.S. default or anything of that sort, this is an unsustainable fiscal trajectory that needs fixing. So I think it's a simpler kind of a thing.
So here's what I hear you saying, and I don't think what he's saying is conspiratorial. I think what he's doing is he's assessing what he sees as a strategy. I think he sees a strategy in play, and I think what by your explanation, you don't think there's much of a strategy. You think it's very. No,
I just think it's a very simple strategy.
Yeah, I think you think what's happening is very simple-minded. I want tax cuts. I'm going to cut a bunch of things, and I don't think it's
simple-minded. I just think there is,
meaning there's no broader economic strategy at play here. That's what I'm trying to say.
I think there is. I just think I think you can boil the strategy down to saying historically what Republicans push for is deregulation and lower taxes. That's not this administration. That's the past several. I don't think there is a structural difference in intent here. I think those are the things that can pass the Republican Congress, where those kinds of ideas are core ideas. And I think the only way you do that without ramping up, to the tweet's point, the only way you do that without ramping up inflation and blowing out the deficit is cutting spending. And the way you try to do that is through fiscal reform. The question is, can you do it, and will it work?
I agree with that. Shout out to Flower Power, who is listening while working out. Hopefully you get a personal best here today. Let's go with the second one, which is a bit more loosely related, I think, to the economy and more in the world of political, but it comes from your friend over there in California, Chamath Palihapitiya. This got a lot of play on Twitter. Trump is more popular with young people than old people. Most young people don't own stocks or homes, aka they are asset light. 2, Trump is more popular amongst working and middle class folks. Most of these folks are also asset light. It stands to reason that a fall in asset prices, stocks down or home prices down, have very little impact on his core constituents. To that end, I won't be surprised if Trump has little reaction then to an equity or home price market correction. Separately, the upside of shrinking these asset prices is that it gives the folks mentioned above a legitimate chance to buy into those markets at lower levels, making equity ownership and or home ownership more possible. Tangentially, if Trump figures out how to get rents lower, he will unite young people and asset-light working people into a reliable voting bloc for the foreseeable future. He will have given them the trifecta: cheaper stocks, cheaper homes, lower rent. Said differently, don't presume that the stock market going up is a useful barometer anymore. In fact, it going down may be a better signal for his popularity. Time will tell. There's a couple things I felt or tickled me a little bit about this. One, I think there was some meme floating around about this tweet. It was like, that meme is like the Drake thing where he's like broke, and where Drake was like, no. And he's like asset light. Like, yes. Yeah. So that sort of tickled me a little bit. The third, I thought it's interesting analysis, but it never factors in employment, right? So if you can somehow get all these markets to go down in value and everyone keeps their job, I'm sure he would remain pretty popular. But if these things go down in value and everyone loses their job, I think that could change this calculus just a little bit. Anyways, what do you think? What's Ilya's reaction to his California friend, Chamath Palihapitiya?
To quote a great economic philosopher of our time, Mr. Ace Ventura, fiction can be fun, but I find the reference section much more enlightening.
Go on.
You could say all of these ifs, whens, buts, what have yous, or you can look at the consumer confidence data that's already out. Are consumers happy? No. No, they're not happy. Consumer confidence is tanking. And you're not just hearing that from one source. A multitude of reports now that poll consumers are telling you what's going on. And moreover, this is where it gets really, really fun. The University of Michigan actually takes consumers and breaks them down by political party, because what they notice is magically Republicans became really happy with the economy as soon as Trump took office, and Democrats became really unhappy, even though the economy didn't change very much. So the biases are certainly there on both sides. But the real question here is, first of all, to your point, why are stocks going down? If they're going down because people are looking and saying, oh my God, there's a recession scare, it's not going to get anybody happy, because that's job losses. People's wages are going to fall off a cliff. So that's one thing. The other thing is, let's, for a second, take the premise here. It is certainly accurate. And this, by the way, this is the essence of truly excellent propaganda. Truly excellent propaganda begins with a kernel of verifiable truth. Otherwise, nobody believes it. It is absolutely accurate that folks toward the lower middle and down on the income distribution are asset light, and younger people are asset light. Yes. But also the idea that the stock market has somehow ceased to be a sentiment indicator magically, and that they don't care, is ridiculous.
I don't think so. I actually agree with that part of the statement. I think that his first administration, people were pissed off that he was doing this, that he kept using the stock market as sort of his barometer of success. And I remember a lot of opposition was really pissed off. Like, that's not, the opposition would say that, that's not a reflection of whether or not there's good governance, of whether or not people are happy about the government. I tend to agree with that. And I do tend to agree that this second presidency, I think it depends. I think he'll take what he gets. If you get all-time highs, he'll be cheerleading the stock market. Yeah. But I think that's a very low probability given the policies that they're implementing and the negotiations that they're attempting. And I think the much more likely scenario is that we're going to have at least the first part of his administration. That's not going to be the case. I don't think he's going to be cheerleading new stock highs. So the likelihood he will be finding other things to champion or to promote than the stock market. I think that's probably likely true.
I agree with you there. What I mean isn't his sentiment. I agree with everything you've just said. I don't buy the idea that people that are asset light are immune to sentiment signals from the stock market going lower just because they're not bought in, or they're not bought in to the same extent. Because I think those optics matter, and I can tell you why I think that. It is because the premise that young people are asset light ignores what they are not light on. And ignores the fact that we're still looking, despite some recent gyrations, at a crypto bubble that is primarily driven by young people's buoyant risk appetite. And if they are paying attention. And the only reason you have this crypto bubble is because they are not risk averse. Go ahead, make them risk averse.
That's a really good point. So they might not
see if that doesn't make an impact.
They might not own a home, or they might not own Apple, but they do have a wallet full of fart coin, and so they.
Of course they do.
They're gonna be pissed. They're gonna be pissed off.
See, AMC to the moon, baby, diamond hands. What? No, that's boomer culture. Stop. Come on.
I think I can get down with what you're saying. I think what the faulty premise here is really, to me, is it ignores the idea that if you're asset light, what you are doing to feed yourself, which is exchanging your labor for wage.
Yes.
And it would be some sort of like Virgin Mary miracle if you could get home prices to come down and stock prices to come down, and one of these two things don't also happen. One, you don't lose your job, or a majority of this constituency doesn't lose their job, along with lower stock and home prices. To me, it was like, how does that work? That's number one. Number two would be, why wouldn't, in that scenario, if nobody's lost their job, which means we're in some sort of contraction but not recession, why wouldn't capital just buy up the cheaper houses and the cheaper stocks?
And so I just think what have we seen from the likes of the BlackRocks and the Blackstones of the world, and how much housing they own already?
It's a weird premise. I just don't get the premise that he's speaking to.
I think you can.
So the likelihood that you lose your job means you're pissed off, and if you're pissed off, you don't vote for the incumbent. So I just don't get this magical miracle world that he's painting here. That's my issue.
No, I don't get it either. I don't get it for a whole host of reasons. The one you describe is obviously the most straightforward and the most obvious, but I think there are other things, like this whole premise that Gen Z is immune to asset prices. I mean, these are the people who made all of the money in the tech boom right now. The past 10 years, they're asset light. All of them have 401ks. All of them check those. Like, these are wild generalizations. There is a kernel of truth to them, but I don't follow if X then Y logic that he's laid out here. I think he's ignoring wildly how things really work.
All right, my friend. Let's head back over to a topic. We had some more agreement there than I thought. I thought we'd be arguing about that for the next 30 minutes. It's way more,
Don't worry,
way more
we've got
agreement.
time. We'll find something.
We do have a little bit of time, so let's go to Bitcoin. Why not? When in need of, so I'm not so sure we're going to disagree on this either. So on Sunday night, there was the tweet ahead of. So we got a couple of things coming up. We have Trump's address to Congress tonight, and then on Friday we have the U.S. Crypto Summit. Along with NFP, along with Jerome Powell's speech.
Yeah.
But I just want to focus on the crypto part of this. So on Sunday, President Trump tweets something about the Strategic Working Reserve, that he's instructed this working group, this crypto working group, to move forward with the Strategic Reserve. He tweets about 5 different crypto assets. I think it was Ripple, Cardano, Solana, Ethereum, and Bitcoin. I think we're the 5. Bitcoin has this crazy run, $10,000 on Sunday night, which gets immediately reversed. So I'm not going to ask you what you think about the price, because I know you're not a big fan. So I think you'll be leaning on the bear side no matter what. $1 is probably too expensive for you.
And you can't really short it, so I'm just standing aside.
But I'm more interested to get your thoughts on this idea of creating a strategic crypto reserve. The idea of allocating taxpayer dollars towards a basket that, of the top 5 most liquid of these crypto assets right now. What does Ilya Spivak think about that?
I was thinking about this the other day as I was reading the article about El Salvador abandoning crypto as legal tender in order to get an IMF loan.
Oh, yeah. I mean, they were bullied into that. They don't want to.
But they needed the money, though. They needed the money. Bottom line is, if they'd figured out the golden opportunity, and if everything was in fact so great, they wouldn't need the money. But they needed the money, and so they had to do what it took to get the money. So, facts. I mean, they decided that they needed money.
Why would you assume that switching to Bitcoin would fix everything, every economic problem in their country inside of 2 years? I know, but that you've just set up that straw man. You basically said if everything was so fine, you wouldn't need the money.
I think that's what Nayib Bukele was trying to tell us, that he was going to turn El Salvador.
Why does the IMF care? Isn't that a better question? Why is the IMF bullying?
Because I think the IMF
cares.
cares. Because I think the IMF says we want fiscal rectitude if we're going to give you money, and we do not think it is a responsible thing to spend a bunch of public finances on buying this thing when you are asking us for more money because you are broke. So if you are going to do things,
I could take you to task on that premise.
I mean, it doesn't matter. Whether the IMF has made mistakes in the past, boy, have they. It's a long list. Whether they've made mistakes in the past in Latin America, specifically, long list. We could be here until tomorrow going down all the various things the IMF got wrong in Latin America. I'm staying specifically with this topic here now. I don't think it is illogical for the IMF, but that's besides the point. I think the creation of a crypto reserve in the U.S. and the abandoning of crypto as legal tender in El Salvador is it's juicy coincidence.
Why? Explain.
One of the biggest champions of making it legal tender is having to backtrack. Meanwhile, the U.S. wants to lean in. Ultimately, I don't think these things are connected. I don't think they're affecting each other. I just think that's why I call it coincidence. I just think it's fun optics for these things to be happening at the same time.
I agree. It's sort of it's juicy irony, I think.
Yeah, it's juicy irony. Exactly. I think from the U.S. perspective, I don't think the crypto reserve means much. Okay, have one. Fine. And I think ultimately the future of crypto, in my mind, has always been more about the technology than about this or that token. Because I think the technology is much more useful in the creation of a payment system that runs through the Fed efficiently, cuts out the banks, and makes transacting cheaper and faster for those people that are debanked, and for those people that don't want to get hit with fees, and basically forces the banks and banking services into the kind of deep discounting and more broadly opening those services to more people that happened with the asset management industry, which used to be the province of rich people and went to deep discount once costs came down, liquidity improved. It had to basically become a mass market retail thing. I think to the extent that full service banking could become that and hasn't yet, and there's still crazy fees and the service kind of sucks if you don't have a bunch of money there. I think that's the disruption that crypto is going to have, and it's because of a digital dollar built on blockchain technology that allows the Fed to basically say we can give people payments clearing without them having to keep their money at a bank necessarily, and to lower those fees that banks charge and all the other juice that the banks extract from the financial system intermediary function, especially at the retail kind of consumer level. So to me, the government becoming a giant holder of crypto after the government basically institutionalized crypto as a non-exchange asset by allowing the ETFs, what it does is it basically takes crypto further and further and further and further away from being an alternative, an anti-government other system, and instead brings it closer into the purview of the man. And I always expected this was what was going to happen.
Bro,
so,
it's like we're dancing. Did you watch yesterday's episode or something? I said yesterday, no. I go the minute BlackRock launches an ETF and starts accumulating this stuff with other people's money, and then puts out a report that encourages people to hold 2 to 3% of their wealth in this asset, that's the moment this is no longer an anti-institution.
These aren't pirates anymore. Yeah. If you thought Ross Ulbricht was the dread pirate Roberts, let me tell you, you're living in yesterday's narrative.
I said the same thing, bro. What the hell's going on with this episode? This episode's called Common Ground.
I mean, listen, if you wanted a reason to get on the short Bitcoin side of the equation, let's go. The weather's warm. Because what this means then is, again, that the future of digital money is digital government issued tender. It isn't any of these other things. So if you've been hodling all this time, if you're Michael Saylor and you've been hodling all this time, Bitcoin specifically, you were right thematically that the technology is transformational. What you're not going to get is a parallel anti-legal tender payments system or money.
I'm not so sure. I think it's easier to use Bitcoin as a Trojan horse than it is to introduce a new thing and force everybody into it. I'm not so sure.
You might be right. I don't have a strong.
Yeah. I do see what you're saying, and that was always the case against Bitcoin. That at some point the government can just wave the magic wand, and it's gone. But I think if that was the case, it would have been done already. And if that was the case, I don't think these major institutions would have. They could have easily done this.
I don't think they want to kill it. I think they want to co-opt
exactly.
it.
It's serving some useful purpose.
No, they want to co-opt it.
I think that's why it's still here.
I don't think they want to kill it. I think they want to co-opt it.
Yeah, I agree. All right, man. This is weird. I don't like agreeing with you. But I don't love the idea for other reasons. So let me run this by you and just get your reaction. I don't love the idea. I think you are somewhat neutral on the idea. I don't love the idea of a Bitcoin or a strategic reserve.
I don't think it's a good idea. I just don't think
I don't think so either. I think he's paying back. I think he's paying back his donors.
Maybe so, yes.
I think he's paying back his donors, and I think I don't love situations where we do government handouts. On the left, it's like, I'm going to give billions of dollars to Intel, and that's how we're going to, you pick a winner and then you give them a bunch of money instead of creating an incentive structure that's going to get a bunch of participants to compete for that outcome. I would much rather see us do smart policies like that, but instead we go, hey, Intel, you're strategically important, or hey, bank, you're too big to fail, here's some money. Like, we do that. We say, you're going to be the winner. And here it seems like, in this nascent industry, us creating this strategic reserve and buying the top 5 most liquid assets, that just doesn't mean we're just going to keep buying new coins in 5 years. You can't tell me those 5 are going to be the top 5 most liquid.
Sure.
So I don't get the strategic part of this strategic reserve. What is strategic about it and how we invest? It's just some guy is going to decide whether or not it's time to add more. Like, what is the strategic part of this? And I suppose we'll learn more of that on Friday. But I think it's just picking winners in the crypto universe as opposed to in the stock universe, in the economy. And I don't love that. What do you think about that, Alien?
I mean, I think that's right. I think of the many ideas that have come out of this administration, this isn't one where, I mean, there are some good ones, by the way. I'm not by any means suggesting that they're all bad. Not in the slightest, by the way. But there are some that I think are ludicrously misguided. This one, I think, is relatively muted in terms of its near-term impact one way or another. But if you asked me, all things equal, would you do this? Well, if I wouldn't go buy crypto with my money, why would I think it's a good idea that the government buy it with my money on my behalf? No, thank you.
That's so funny. But here's my thing. It's not like, okay, if it's cognitive dissonance at its finest, right? Because we're talking about our deficit problem, right? We're out here trying to find waste, fraud, and abuse. And before we've cleared the debt, this isn't surplus funds going into this.
And this is why the El Salvador
reserve.
parallel is at the same time is funny.
No, it's not. Dude, they wouldn't. The IMF is just a bunch. I don't know why you're doing that. It's a straw man argument. The IMF is a bunch of gangsters who force them to give it up. They don't want to give it up.
It's just funny. It's funny because they have to.
It hurts my heart. It hurts my heart that you're a supporter of the IMF.
It's not about being a supporter of the IMF, although I do think the IMF does a lot of good. I think it's also made a ton of mistakes. You can hold both of those ideas in your head at the same time.
Those are the organized economic gangsters of the world. Oh, it'd be a shame if something happened to all your minerals.
I don't.
You need a loan?
I don't look at it that way. I just think it's funny that at the very time that we're so concerned about fiscal extravagance, that we want to have that we want to take taxpayer money and buy a highly speculative and liquid asset at the highs.
Nothings.
At the highs, mind you, not even cheaply. We're not even going to buy them cheaply. And at the same time, the Bukele government, which was the biggest champion, has to go,
to
Bro,
the
stop
IMF of
bringing
all
him up.
places. The thing
they're not they
the thing it reviles most. It had to go to the globalist cabal to ask for money, and in return had to abandon legal.
You're so right about
crypto.
the first part of that, and you're using the way you're framing El Salvador is so incorrect. But we don't have the time. Ilya, if people want...
we could have had a debate on El Salvador if only it mattered for the S&P.
All right, Ilya Spivak, it's always a pleasure, my friend. I say this every time. They could give us 3 hours, and it probably wouldn't be enough. You are a fountain of knowledge, and you smell like Tiger Balm 95% of the time, which means you're full of wisdom, my friend.
And responsibility.
You smell like experience and responsibility. Ilya Spivak, if the people want more from you, tell them where they can go.
As ever, I'm all over the network. Macro Money and Overtime are Monday through Thursday on Tasty Live after the close. We are also here every Tuesday for this show. You and I talked to Tom at the start of the week for first call. I'm on with Chris for Futures Power Hour Mondays and Fridays midday. I'm writing for the News and Insights portion of tastylive.com. I'm commenting wherever social media is there to comment on. I'm on Twitter and on Blue Sky at Ilya Spivak. Come check that out. And if there's another social media platform that looks attractive, I'm probably there too.
Do we break 5,800 this week, and does it get ugly?
I think it gets real ugly.
I'm hoping. I think if we break 58, we're going to get wherever we're going. We're going to get there fast.
Yeah.
We're going to get there in like 2 or 3 days.
Well, that's the thing, right? Markets. Chris always says this, and I agree. Markets are staircase up, elevator down.
I don't think he came up with that one. That's been around for a while.
No. I don't think he came up with it, but he repeats it a lot, and
For sure.
I think that's the correct assessment. I think stocks
Except
don't like going
2022.
down.
2022 was wild. It was the opposite. But
Yeah,
I agree with you.
Yeah. Well, the kind of rate hike cycle we had, it's not surprising. I mean, Fed's out here doing 75 basis point clips back to back. What are you going to do?
All right, man. It's always fun. Everybody out there, do me a favor before you get out of here. Hit the like button, subscribe to the channel if you haven't already. Make sure you follow Ilya on all of his socials. If you want to follow me in the ramblings of a madman, often incorrect and only slightly coherent, you can follow me at Victor Jones on Twitter. Again, at Victor Jones. The Owen Jones is 0 because I like to be difficult. I'll see you back here with the one and only Chris Vecchio tomorrow. Same time, same place, same great network, only on Tasty Live. Peace.